The saving paradox. Paradox of thrift. Saving builds discipline, provides security, and prepares households for emergencies. It allows individuals to invest, handle financial shocks, and plan for future. On a personal level, saving is a wise financial decision. But if everyone saves at the same time, especially during an economic downturn, it can harm the entire economy. That's the saving paradox, also known as the paradox of thrift. What's good for one person becomes harmful when everyone does it simultaneously. The logic behind saving is simple. You earn money, spend some, and put the rest aside. That saved money can later be used for consumption, investment, or retirement. However, your spending today is someone else's income. If you cut back on dining out, delay repairs, or skip upgrades, the businesses you would have paid earn less. Their employees get fewer hours, and their suppliers sell fewer materials. The money you keep in the bank doesn't circulate. Multiply that behavior across millions of households, and the economy starts to slow. In a recession, people naturally become cautious. Job losses rise, incomes shrink, and uncertainty grows. People respond logically. They cut back on spending and increase their savings to prepare for the worst. This makes perfect sense at the individual level. But when everyone does it at once, total demand across the economy falls. Businesses see declining sales, they lay off staff or shut down, and unemployment rises even further. Fear increases, and the cycle deepens. Efforts to protect personal finances can end up hurting the collective economy. This feedback loop turns a downturn into a prolonged slump. The original shock, whatever caused a recession, is made worse by a collapse in demand. The economy contracts not just because of the initial event, but because consumers pull back. Even people with stable jobs and incomes become more cautious. They save more, and that reduction in spending ripples through every sector. Consider a basic example. A small town suffers a factory closure. Hundreds of workers lose their jobs. In response, families begin saving aggressively. They stop eating out, delay car repairs, and cancel vacations. Local restaurants, garages, and hotels lose revenue. To cope, they lay off staff. More people lose income, and they, in turn, spend even less. The slowdown spreads from a single factory to the entire community. Fear fuels contraction. The paradox is that well-intentioned choices make things worse. If one family saves 20% of its income during a crisis, it may fare better. But if every family does the same, the storm intensifies. Incomes shrink across the economy. The pool of money available for wages, services, and investment dries up. Even though households are saving more individually, total savings may not rise because the economy, the pie, is shrinking. People are trying to protect themselves, but the collective result is a weaker economy. This problem is specific to economic downturns. In a growing economy, saving doesn't have the same effect. One person's saving can be matched by someone else's borrowing or investment. Banks lend those savings to businesses, and spending continues. But in a recession, borrowing and investment fall too. Businesses don't want to expand. Consumers avoid taking on debt. Even if savings are available, no one wants to use them. The system stalls. Keynesian economics highlights this issue. John Maynard Keynes argued that total demand drives output and employment. When private demand falls, government spending should rise to fill the gap. That's the argument for stimulus. Public investment keeps money moving when households and businesses pull back. It provides people with income so they can continue to spend. Without that intervention, the economy risks a self-reinforcing decline. During the Great Depression, this paradox was clearly visible. People hoarded cash, banks failed, and confidence vanished. The result was a collapse in demand that lasted for years. Franklin Roosevelt's New Deal programs were an attempt to break the cycle. Public works, Social Security, and labor programs injected money into the economy. More recently, the 2008 financial crisis followed a similar pattern. After the housing bubble burst, households cut back sharply. Many were over-leveraged. Others were simply afraid. Spending dropped across the board. Businesses laid off workers. Investment froze. The Federal Reserve cut interest rates, but fear remained high. It took years for demand to recover. Even as savings rose, the economy stayed weak because there wasn't enough spending to support full employment. The COVID-19 recession added a new layer. Lockdowns forced people to stop spending. Households saved by default, but the result was the same. Businesses lost revenue, workers were laid off, and total demand collapsed. This time, governments responded quickly with large stimulus checks, expanded unemployment benefits, and emergency lending. These measures aimed to break the cycle by giving people money, so they could keep spending, even while saving. It worked better than in 2008, but the underlying paradox remained. The saving paradox reminds us that the economy is a system of relationships. Your spending supports someone else's job, and their spending supports yours. When everyone acts in their own best interest, the group outcome can suffer. This idea appears elsewhere too. If everyone tries to sell a stock at once, its price crashes. If everyone withdraws money from a bank simultaneously, the bank fails. In these cases, individual rationality creates collective instability. Solving the saving paradox isn't about telling people not to save. Households need financial security, but it means recognizing that saving alone won't restore growth during a recession. If everyone cuts spending at once, the economy contracts. The solution lies in policies that support demand, fiscal stimulus, job guarantees, infrastructure projects, and social safety nets that foster confidence. When people feel secure, they're more willing to spend, and when spending returns, so does growth. This paradox also challenges some cultural values. In many societies, thrift is seen as a virtue. People are praised for being frugal, living below their means, and saving for a rainy day. These are good habits individually, but in the aggregate, they can slow economic recovery. The economy doesn't just need savers, it needs spenders. Not reckless consumers, but people willing to buy goods, hire services, and invest in their lives. That activity creates jobs, supports wages, and powers recovery. Understanding the saving paradox means thinking beyond personal finance. What's right for you might not work if everyone does it. That's not a contradiction. It's a systems problem. Economies aren't just collections of households. They're dynamic networks. One person's income depends on another person's spending. And in downturns, the instinct to retreat can deepen the very crisis people are trying to escape. The risk-return paradox. In the world of investing, the concept of risk and return is a fundamental principle. Generally, the higher the risk, the higher the potential return. This idea is based on the premise that investors demand greater rewards for taking on greater uncertainty. The reasoning is simple. If you're willing to put your money into something that could lose value or be highly unpredictable, you should be compensated for that risk with a better return. However, this theory does not always hold true in the real world. There are instances when safer, lower-risk investments outperform riskier ones over extended periods. This paradox challenges a common assumption that risk and return are directly correlated. To better understand this phenomenon, consider some examples where safer assets have outperformed riskier ones. One of the most well-known is the long-term performance of U.S. Treasury bonds compared to stocks. U.S. Treasury bonds, considered among the safest investments, have historically outperformed stocks over certain periods. For instance, over the past few decades, investors in Treasury bonds have enjoyed consistent returns while stock markets have experienced significant volatility, including extended periods of poor performance. In such cases, the higher risk of stocks did not lead to higher returns. A major reason for this paradox is market cycles. While stocks may offer higher returns in the long run, they also go through significant downturns. During economic recessions or financial crises, stocks can lose a substantial portion of their value. Bonds, particularly government-issued ones, tend to be more stable during such times. As markets become volatile, investors often seek the safety of bonds, driving their prices up and enhancing their returns. This cycle can result in periods where bonds outperform stocks, despite the latter's higher long-term potential. A similar example is a comparison between large-cap and small-cap stocks. Small-cap stocks generally have higher growth potential due to their size and growth capacity, but they also come with greater risks. In contrast, large-cap stocks, typically from well-established and financially stable companies, often provide more consistent returns. During economic uncertainty, large-cap stocks tend to perform better because of their stability and access to resources. Macroeconomic factors can also enhance the performance of safer investments. For example, in low-interest rate environments, bond yields may decrease, but demand for bonds can rise as investors seek predictable returns. These periods often coincide with market instability, when riskier assets like stocks may underperform and safer assets offer steadier outcomes. One notable period where this paradox was evident was after the 2008 financial crisis. Following the market crash, stock markets took years to recover, with many investors suffering major losses. Meanwhile, government bonds, especially those from stable countries like the U.S., delivered steady, positive returns. This happened because, during times of crisis, investors become risk-averse, increasing demand for safer assets and thereby boosting their performance. Another contributing factor to the risk-return paradox is investor behavior. Many individuals are attracted to potential high returns from riskier investments like stocks or startups, but they often underestimate the risks. Poor timing, emotional decision-making, and lack of risk management can lead to underperformance, even when higher returns are theoretically possible. In contrast, safer investments tend to produce more predictable results, especially when held over time. Moreover, the perception of risk is subjective. What seems risky to one investor may not be to another. A young investor with a long time horizon may tolerate stock market volatility, viewing it as a normal aspect of long-term investing. Conversely, an older investor nearing retirement may see that same volatility as a major threat and prefer the stability of bonds or dividend-paying stocks. Diversification also plays a crucial role in managing risk. By spreading investments across various asset classes, sectors, and geographies, investors can reduce exposure to the volatility of any single investment. Diversified portfolios often perform more consistently over time, as poor performance in one area may be offset by gains in another. Volatility itself is a key part of this paradox. While high volatility can lead to high returns, it can also undermine long-term wealth accumulation. During turbulent markets, emotional decisions, like selling at lows and buying at highs, can hurt performance. Even if riskier assets offer greater potential, volatility can cause investors to abandon strategies prematurely, resulting in lower actual returns. In conclusion, while traditional theory suggests that higher risk leads to higher returns, real-world outcomes often defy this assumption. Safer, more stable investments can outperform riskier ones during periods of economic uncertainty or instability. The key takeaway is that the relationship between risk and return is not always linear. Investors must carefully consider their own risk tolerance, time horizon, and the broader economic context when making decisions. The value growth paradox. The debate between value and growth stock centers on two fundamentally different investment philosophies. Value stocks, those priced lower than their intrinsic value and often backed by a strong track record of profitability, tend to outperform in the long term. Growth stocks, on the other hand, are typically companies expected to grow at an above-average rate relative to their industry or the broader market. These companies attract significant investor attention, especially in the short term. Despite historical evidence favoring value stocks for long-term returns, investors consistently chase growth stocks in hopes of finding the next big winner. This behavior creates a paradox. Value stocks are statistically the better long-term investment, yet investors continue to pour capital into growth stocks. The main reason for the allure of growth stocks lies in their potential for rapid, substantial gains. Investors are drawn to companies that are expanding quickly, innovating, and capturing market share. These stocks often hail from emerging industries, such as technology or biotechnology, where businesses appear poised to dominate their sectors. The promise of future returns not yet reflected in the current stock price is highly appealing. When people see a promising tech startup or a breakthrough pharmaceutical company, they envision skyrocketing revenues and growing market dominance. The idea of buying early, before a company becomes a household name, is compelling. However, the reality is that most growth stocks fail to deliver on their promises. Many highly valued companies are built on speculative assumptions about future performance, and when that growth doesn't materialize, stock prices can drop dramatically. In contrast, value stocks, which are already priced below their true worth and often backed by solid fundamentals, tend to offer more stable and consistent returns over time. These companies may not post explosive growth, but they usually deliver steady dividends, reliable earnings, and lower risk, characteristics that contribute to solid long-term performance. Still, value stocks are often perceived as boring or uninspiring. They tend to be established businesses in mature industries, far removed from the cutting-edge appeal of the latest tech or disruptive innovation. They're not the subject of media hype or social media buzz, and their incremental gains make them less attractive to thrill-seeking investors. With lower price-to-earnings ratios and slower growth prospects, they don't match the high-octane appeal of growth stocks, which often carry inflated valuations based on potential alone. During bullish market periods, this dynamic becomes even more pronounced. Investor sentiment and optimism can drive growth stock prices to unsustainable levels, fueled by media enthusiasm and the fear of missing out FOMO. The dot-com bubble of the late 1990s is a classic example. Investors flooded into technology companies, believing the internet would reshape the economy. Many of these businesses were overhyped and underfunded. When the bubble burst, countless growth stocks collapsed, leading to massive losses. Yet despite repeated cautionary episodes, investors continue to chase the next Amazon, Tesla, or Apple, hoping to catch lightning in a bottle. FOMO plays a major role here. Seeing the success of early investors in today's tech giants leads others to seek similar opportunities, even if the odds are slim. Stories of dramatic success drive a narrative that favors growth investing, even in the face of long-term data supporting value strategies. Adding complexity to the paradox is the fact that growth stocks tend to outperform during strong economic expansions. In times of booming economic activity, companies in fast-growing sectors, especially tech, often achieve impressive short-term gains. But when the economy slows or contracts, growth stocks typically suffer. Their high valuations depend on continued earnings acceleration, and any sign of deceleration can send their stock prices tumbling. Value stocks, by contrast, often remain more stable during downturns. Their prices already reflect lower expectations, and their revenue streams are more predictable. Over extended periods, value investing tends to outperform growth investing, particularly on a risk-adjusted basis. Value stocks are typically priced more conservatively, which makes them less volatile. They also tend to offer higher dividend yields, providing investors with a steady income stream that can compound over time and contribute meaningfully to total returns. Growth stocks, in contrast, often reinvest all earnings into expansion, offering no immediate cash flow to shareholders. Despite all this, the appeal of growth stocks remains remarkably strong. Their excitement and potential drive investor behavior. There's a psychological dimension to investing in growth. The thrill of possibility, the dream of backing the next market giant. In contrast, value stocks, despite their historical performance advantage, lack the flash and headline appeal. They are dependable, but not glamorous. Media and the broader financial industry amplify this trend. News outlets spotlight hot growth stocks, fueling investor enthusiasm. Financial analysts and fund managers often prefer growth stories. They're more exciting to pitch and easier to market to clients. This media attention creates a feedback loop where investors chase the newest high flyers instead of focusing on dependable returns from undervalued, profitable companies. What's most striking is that this paradox persists even when evidence consistently shows that value investing delivers better long-term returns. Numerous studies affirm that value stocks outperform growth stocks over extended horizons, especially when adjusted for volatility and risk. Yet the drive for quick wins, emotional excitement, and media buzz keeps growth investing at the center of attention. Ultimately, the value growth paradox underscores a deeper truth about human nature in investing. People are driven by emotion, excitement, and short-term thinking, even when long-term data points to a different course of action. While value stocks offer a more stable, reliable, and rewarding path for the patient investor, many remain captivated by the allure of dramatic gains. In the end, those willing to tune out the noise and take a long-term view may find that value investing, though often overlooked, provides a more sustainable road to financial success. The cash paradox. The cash paradox is a term often used to describe the fluctuations in the price of an asset a market, or an entire economy. In finance, it is generally viewed as a measure of risk. The prevailing belief is that high volatility equates to high risk, which shapes how investors behave. When volatility is high, they tend to act more cautiously. When it's low, they often feel emboldened to take on greater risks. This is where the volatility paradox comes into play. Periods of low volatility are frequently followed by sudden spikes in volatility. In other words, when markets appear calm and stable, there's often an underlying risk that volatility could surge. This paradox arises from the dynamics of market behavior. During low volatility periods, markets seem stable, asset prices fluctuate within a narrow range, and there is a general sense of normalcy. Investors feel more confident and may take on riskier investments or maintain positions they might otherwise avoid. This sense of security encourages borrowing and speculation. Investors may continue buying assets or taking out loans, expecting the steady upward trend to persist. In the short term, low volatility fosters confidence, but this calm can be misleading. Volatility is cyclical and often follows recognizable patterns. A long stretch of low volatility can create conditions ripe for a dramatic reversal. The lack of major disruptions means fewer price corrections, but underlying risks are quietly accumulating. Eventually, some event, a surprising economic report, a geopolitical shock, or an unexpected market movement, disrupts the status quo and triggers a surge in volatility. One way to conceptualize this is to imagine the market as a pressure cooker. It may appear quiet and stable, but pressure is building beneath the surface. Risk-taking increases, economic shifts occur, and uncertainty grows. When the pressure finally releases, the resulting spike in volatility is sharp and fast as investors rapidly adjust to new information. A striking example of this paradox was the financial environment leading up to the 2008 crisis. Before the collapse, volatility was low. Asset prices, especially in housing, were steadily rising and optimism dominated. Investors were confident, banks lent freely, and the market seemed stable. But risks were quietly mounting. The housing market became increasingly overinflated, and risky financial instruments like mortgage-backed securities were widely traded with little scrutiny. When the bubble burst, the resulting market volatility was extreme, amplified by the complacency bred during the preceding calm. Another instance occurred in the calm that followed the dot-com crash in the early 2000s. In the years after the initial market collapse, volatility subsided and markets regained stability. This lull led many to believe the worst was over. But by 2007 to 2008, another financial crisis erupted, once again catching many investors off guard. The cyclical relationship, low volatility today, high volatility tomorrow, is driven by how markets digest information. When there is little movement in prices, it may be assumed that all available information is already factored into asset prices. This false sense of efficiency reduces reactions to news. But when a disruptive piece of information surfaces, especially one that contradicts the prevailing outlook, markets react strongly and simultaneously, leading to sharp price swings. The volatility paradox isn't limited to financial markets. The same principle applies to entire economies and industries. Periods of stability often lead to complacency. Businesses, assuming steady growth, may overlook shifts in consumer behavior, technological changes, or regulatory risks. In sectors like technology, long periods of smooth growth can be appended by sudden breakthroughs or changing demand, leading to sharp corrections in company valuations. For investors, understanding the volatility paradox is crucial for effective risk management. Those who ignore it may grow overconfident during quiet periods and overexpose themselves to risky assets, expecting stability to continue. When volatility returns, they may suffer substantial losses. Conversely, those who anticipate the paradox may exercise greater caution during calm periods, diversifying their portfolios, and using hedging strategies to protect against potential shocks. The paradox also emphasizes the importance of long-term thinking. Many investors focus on short-term market fluctuations, attempting to time the market for maximum gain. However, those with a long-term strategy tend to weather volatility more effectively. By maintaining diversification and avoiding knee-jerk reactions to market noise, they can sidestep the emotional pitfalls of turbulent markets. Ultimately, the volatility paradox highlights the unpredictability inherent in financial systems. Low volatility may breed complacency, but it also sets the stage for future turbulence. High volatility, on the other hand, may create opportunity for those who are prepared. By recognizing the cyclical nature of volatility and understanding that calm periods can be precursors to disruption, investors can adopt a more strategic and resilient approach to managing their portfolios. The cheap stock paradox. The cheap stock paradox often catches the eye of investors looking for a bargain. A stock trades at a low price-to-earnings ratio, or well below its historical average. Maybe it's trading under book value. Maybe the price has fallen 60% in a year. On paper, it looks like an opportunity. Buy low, wait for the market to realize its mistake, then sell high. That's the thinking. But here's the problem. Cheap can always get cheaper. Just because a stock is down doesn't mean it's done falling. The cheap stock paradox reminds investors that low valuation is not the same as good value. A stock is often cheap for a reason. Sometimes that reason is simple overreaction. The market panics after a bad quarter, news hits hard, and sentiment collapses faster than fundamentals justify. If the underlying business remains strong, the price drop may be temporary and a potential opportunity. But more often, a falling stock reflects real, lasting problems. The business model may be deteriorating. Revenues may be shrinking, costs rising, management losing credibility, or the company may be stuck in a dying industry. In such cases, a cheap stock represents risk, not reward. Consider a company trading at 5 times earnings. That sounds like a deal, especially when the market average is close to 20. But if earnings are falling each quarter, the multiple is misleading. If a company earned $2 per share last year, but only expects $1 this year, the true multiple has doubled. If earnings go to zero, there is no multiple at all. The stock becomes just a ticker symbol with a price tag. That price might be low, but it's not meaningfully cheap. It's just unwanted and possibly for good reason. Investors often confuse low price with undervaluation. A $3 stock may appear more attractive than one at $300, but price alone says nothing. A $3 stock with no earnings, negative growth, and mounting losses may be on its way to zero. Meanwhile, a $300 stock growing profits at 20% a year with strong margins and a solid balance sheet might still be undervalued. Cheapness is not about absolute price, but about value relative to business quality and future potential. A stock is only undervalued if it trades below what it can reasonably produce in the future, and that's hard to estimate. The cheap stock paradox becomes dangerous when investors fall into the trap of mean reversion. They assume that if a stock once traded at $50 and now trades at $10, it must bounce back. They believe the market has made a mistake. But there's no rule saying a stock must return to its previous highs. Companies change. Markets evolve. A business that earned money 5 years ago may never do so again. Retailers go bankrupt. Tech companies get outpaced. Industries get disrupted. A cheap stock may simply reflect a fading company with no clear path forward. Take BlackBerry as an example. Once a leader in mobile phones, it declined when Apple and Android dominated the market. For years, investors pointed to its cheap valuation as a buying opportunity. But the fundamentals kept deteriorating. Market share eroded, revenue fell, and efforts to reinvent itself as a software company came too late. The stock kept falling. It looked cheap the whole way down. So did Sears. So did Kodak. The market wasn't wrong. It was pricing in decline. Another layer to the paradox is liquidity. A cheap stock may trade at low volume. This makes it hard to buy or sell without affecting the price. Investors can find themselves trapped, unable to exit without realizing a loss. This risk doesn't show up in valuation metrics, but it's real. Low-priced, low-volume stocks are often illiquid traps. The bid-ask spread widens. Volatility increases. Small trades can cause big price swings. The danger isn't just further price decline. It's that you may not be able to get out when it matters. There's also a psychological component. Investors tend to anchor their expectations to past highs. If a stock once traded at $100 and now trades at $15, they imagine a return to $100 as a realistic outcome. But that's not investing, it's hoping. And hope is not a strategy. Anchoring to old prices ignores the reasons a stock fell. It assumes the past is a guide to the future, when in reality it may be a warning. The cheap stock paradox teaches that due diligence is essential. Before buying a low-price stock, investors must ask the hard questions. Why is it cheap? What is the market seeing that I'm missing? Are earnings sustainable? Is debt manageable? Is the business model still relevant? Does management have a credible plan, and can they execute it? A stock may be cheap for good reason. In many cases, the price is telling the truth. Even if a cheap stock is truly undervalued, timing matters. The market may not recognize value immediately. A turnaround can take years. In the meantime, the stock might drift sideways or fall further. This is dead money. Capital tied up that could earn better returns elsewhere. Patience is important, but so is opportunity cost. And then there's survivorship bias. We hear stories of cheap stocks rebounding, buying at $2, selling at $20. But we don't hear about the dozens of $2 stocks that went to zero. Turnarounds do happen, but they're rare. For every winner, many others disappear. Chasing cheap stocks without a margin of safety is closer to gambling than investing. A smarter approach is to focus not on how cheap a stock is, but why it's cheap and whether those reasons are likely to change. Sometimes, cheapness signals opportunity. More often, it signals trouble. Companies with strong balance sheets, growing revenue, and capable leadership may be overlooked temporarily. That can create true value. But those with deteriorating fundamentals and declining relevance are cheap for a reason. They don't deserve a higher price. The cheap stock paradox is a warning. Not everything on sale is worth buying. In investing, a low price tag often hides high risk. A $2 stock can lose 100% just as fast as a $200 stock. And the lower it gets, the more tempting it looks, until it vanishes. The earnings paradox. A company reports record earnings. Revenue is up. Profits are higher than ever. Margins are strong. Operating costs are under control. The business is growing in all the right places. And yet, the stock drops. To someone unfamiliar with how markets behave, this seems irrational. Shouldn't strong earnings push the price up? If a company is doing well, shouldn't investors reward it? This is where the earnings paradox comes into play. Stock prices don't move solely on a company's reported earnings. What matters more is how those earnings compare to investor expectations. A company can post strong numbers and still see its stock fall if those results come in below forecasts, or if future guidance points to slower growth. Conversely, a company can report weak or declining earnings and see its stock rise if those results beat pessimistic expectations. In other words, expectations drive the market more than raw performance. Investors aren't trading on what's happening today. They're trading on beliefs about what will happen tomorrow. That includes earnings guidance, forecasts, economic trends, competitive outlooks, and market sentiment. If a company announces its earnings are up 10% year over year, that might sound impressive. But if analysts have been expecting 15% growth, the market reacts with disappointment. The numbers may look strong in absolute terms, but they're weak in relative terms. This dynamic plays out every quarter during earnings season. Analysts set expectations. Companies issue forecasts, and investors try to predict whether results will beat or miss. A beat means actual results exceeded expectations. A miss means they didn't. Even a tiny miss can cause a sharp drop in stock price. It's not about the numbers alone. It's about how those numbers compare to what was priced in. Take a tech company, for example. Suppose it posts a 20% increase in earnings and rising user numbers. Yet if prior guidance hinted at 25% growth, or if analysts were expecting better, the stock might tumble. Investors had already priced in the higher figure. When reality falls short, even slightly, market sentiment turns negative. This is especially true for high-growth companies. These businesses trade at high price-to-earnings multiples because investors expect rapid expansion. Their valuations assume big future gains. That means they need to outperform already lofty expectations just to maintain their stock price. If growth slows even a little, the stock can drop sharply. Investors aren't just buying present performance. They're buying a narrative of explosive future success. Any crack in that narrative can cause a sell-off. Tesla offers a clear example. Over the years, it has posted strong earnings and vehicle delivery numbers. Still, its stock has swung dramatically, driven by changes in guidance, leadership commentary, or future projections. When expectations are built around exponential growth, even a slight deviation can trigger a sharp reaction. On the flip side, companies with low expectations have more room to surprise. A struggling retailer might post a small profit after a series of losses. Analysts expected another loss, so the surprise lifts the stock. The earnings may still be poor relative to competitors, but they exceeded expectations, and that's what moves the price. All of this makes investing seem counterintuitive. Good news doesn't always drive stocks up. Bad news doesn't always drive them down. The market is constantly revaluing companies based on shifting expectations. This is why you'll sometimes see a company report a loss and rally 15%, while another reports record profits and drops 10%. One beat expectations, the other missed. There's also a forward-looking element. A company may report excellent past performance, but issue weak guidance for the next quarter. In that case, the stock may fall, not because of what happened, but because of what's expected. Markets are discounting mechanisms. They price in the future, not the past. That's why earnings calls matter, not just for the reported numbers, but for the language. If a CEO says, "We expect slower growth in the second half of the year," that statement can overshadow an otherwise excellent quarter. Forward guidance weighs more heavily than past results. This helps explain why volatility often spikes after earnings reports. It's not just about the data. It's about how that data compares to what investors believe beforehand. Market participants are constantly asking, was this better or worse than we thought? That question drives price movement. Earnings estimates are central to this process. Analysts set the bar, and investor expectations are anchored to those targets. A company that beats estimates by even a penny can see its stock rally, regardless of whether its business has truly improved. That shows how far expectations can drift from fundamentals. Short-term traders intensify this effect. Many are not interested in long-term company performance. They're playing the game of market reaction. They try to trade ahead of earning surprises, and their moves amplify the market's response. In these cases, the company isn't being rewarded or punished on its own merits. The market is simply reacting to surprise. Earnings, then, are just one part of a much bigger picture that includes guidance, macroeconomic conditions, sector performance, and investor psychology. A strong earnings report can be overshadowed by rising interest rates, geopolitical instability, or weakness in peer companies. Investors never operate in isolation. They respond to a complex network of signals. That doesn't mean earnings don't matter. Over the long term, they do. Companies that grow earnings consistently tend to see their stock prices rise. But in the short term, especially during earnings season, the market reacts more to the gap between expectations and reality than to the absolute numbers. Understanding the earnings paradox helps investors stay grounded. It reminds them that short-term stock movements aren't always rational or tied directly to business fundamentals. What matters is what the market believed before the numbers came out, and how those beliefs shift once new information arrives. The time paradox. You don't just earn returns on your original investment. You earn returns on your returns. Over time, the gains build on themselves. $1 becomes 2, then 4, then 8. The longer you let it grow, the faster it accelerates. On paper, it looks effortless. Invest early, stay invested, and wealth grows slowly at first, then suddenly. But here's the problem. Most of the rewards come after most people have lost patience. That's the time paradox. Compounding works best when you let time do its work, but human nature pushes us to quit just when it's starting to pay off. People understand compounding in theory. They've seen the graphs. They've heard how Warren Buffett made most of his fortune after turning 60. They nod when they hear, time in the market beats time in the market. But in practice, compounding feels frustrating. For years, the growth is modest, so modest it barely registers. A $5,000 investment growing at 7% becomes $5,350 after 1 year. After 2, it's $5,724. That doesn't feel like wealth creation. It feels like watching paint dry. Most people want results now. If they invest monthly, they check their accounts and wonder why they aren't seeing big changes. They compare their slow gains to someone who made a quick profit on a risky trade. They get restless, switch strategies, or stop altogether right when compounding is about to start working. That's the trap. Compounding is backloaded. The early years are boring. The real acceleration comes much later. You might invest for 10 years and feel stuck. Then in year 15 or 20, the numbers suddenly jump. The investment didn't change. Time finally did its job. Take an example. Invest $10,000 at a 7% annual return. In 10 years, it's just under $20,000. Not bad, but not life-changing. Leave it alone for 30 more years, and it grows to nearly $150,000. Over $130,000 of that came after the first decade. That's the paradox. The biggest gains come at the point most people would have stopped paying attention. Buffett illustrates this well. He's known for his investing skill. But the biggest driver of his wealth is time. He bought his first stock at 11 and kept investing into his 90s. That's over 80 years of compounding. Most of his net worth came after 50, not because his returns got better, but because time finally caught up. But staying in that long is hard. Life gets in the way. Jobs are lost. Emergencies arise. Markets crash. Fear creeps in. Articles question the strategy. Someone else gets rich overnight. The temptation to quit or switch or cash out is always there. Compounding asks for one thing, patience, but everything around you begs for action. Modern life doesn't help. Everything is faster now. Food, communication, entertainment. We're conditioned to expect quick feedback. So when an investment doesn't show much progress in a few months, or even a few years, we doubt it. Social media makes it worse. You see someone post a lucky trade or a flashy purchase. Your slow-growing index fund feels foolish in comparison. You start wondering if compounding is even real. It is. It's just slow. That's why most people don't build wealth with it. Even though the math is available to everyone, it requires staying consistent without seeing rewards. It means trusting a process that doesn't feel like it's working. It means ignoring noise, resisting urges, and doing less, not more. That's a hard ask in a world that celebrates hustle and urgency. Some try to speed it up. They chase higher returns. They jump from a 7% fund to one promising 20%. Sometimes it works, but usually it doesn't. They lose money, reset the clock, and delay the benefits. Every detour steals from the future. Every break costs more than it seems. You can't rush compounding. You can't hack it. It runs on its own schedule. Like a tree, it grows at its own pace. Watering it more won't help. Waiting will. What matters is consistency, not intensity. Even small disruptions add up. Pausing contributions for a few years, withdrawing for a vacation, skipping a deposit. It all adds up. The early years, especially, matter more than people realize. Someone who invests $5,000 a year from age 25 to 35 and then stops often ends up with more than someone who invests that same amount from 35 to 65. That's how powerful the early stretch is. Time matters more than amount. This is especially true for retirement. Many people put off saving until their 40s. They tell themselves they'll catch up later. But by then, they've lost the most potent years of compounding. Even doubling contributions can't make up for it. The early years don't just help, they build the entire foundation. And once that time is gone, it's gone. But this idea goes beyond money. Compounding applies to everything: skills, careers, relationships. Small, consistent efforts lead to huge results. Someone who reads 10 pages a day may not look different now, but in 10 years, they've read hundreds of books. The gains always come late. The effort is front-loaded, the payoff delayed. That's why most people give up early. It's what makes compounding feel unfair. The biggest rewards go to those who need them least, those who've already been patient the longest. The early years are thankless. They feel like failure, but they're the most important. They're when compounding is quietly building the base. The paradox of compounding isn't in the math. The math is obvious. The paradox is in the patience, in believing in something you can't yet see, in staying still while everything else says move. The growth isn't linear, it's exponential. And exponential growth always starts slow. In a world that moves fast, that's the hardest part to believe in. The knowledge paradox. Knowledge is power. That's the idea we've been taught since childhood. The more you know, the better your decisions. The better your decisions, the better your outcomes. In theory, access to more information should make you more accurate, more precise, more capable. But in practice, there's a twist. More information often gives the illusion of understanding without delivering actual insight. It leads to confidence without accuracy. That's the knowledge paradox. The more people know, the more confident they become, even when their decisions aren't improving. The human brain craves certainty. When it receives new information, especially if that information appears detailed or technical, it often interprets it as deeper understanding. But not all information is equal. Some is noise, some is contradictory, some is completely irrelevant. Yet, once it's absorbed, it still affects our perception of how much we think we know. This leads to overconfidence, even when the data is misleading or misunderstood. Take investing. A beginner reads a few articles about market cycles, studies some charts, and listens to a podcast or two. Suddenly, they feel prepared. They've seen historical returns, learned some jargon, maybe even watched a few videos on technical analysis. The data is flowing, and with it comes a sense of control. They make trades based on patterns they think they recognize. When one or two work out, it confirms their new confidence. But what they don't see is the vast field of knowledge they've yet to encounter. Macroeconomic shifts, hidden correlations, behavioral traps, liquidity risks. Their small slice of knowledge gives them just enough confidence to make big mistakes. This is common in any domain where decisions are complex and outcomes uncertain. In medicine, a patient might read about their symptoms online. They see a few possible conditions listed and decide which one fits best. They then question a doctor's diagnosis, convinced by the volume of material they've read. But volume is not depth. The information may be accurate, but without the context, experience, and training to interpret properly, it can lead to the wrong conclusion. Worse, it can lead the patient to dismiss expert advice entirely. In the legal world, this plays out when people try to represent themselves in court. They read laws, watch courtroom shows, maybe even look at a few cases online. They come in confident, thinking they understand how the system works. But law is about precedent, strategy, and subtle interpretation. What seems clear on paper often plays out very differently in a real legal proceeding. Their newfound knowledge gives them a false sense of readiness. The paradox deepens in the information age. Today, knowledge is abundant. You can look up anything, anytime. You can get data, context, commentary, and analysis within seconds. But more doesn't mean better. In fact, the easier it is to access information, the less effort we put into filtering it. We absorb facts without asking how reliable they are. We confuse repetition with truth. And the more we absorb, the more certain we feel, even when the information is shallow or biased. Cognitive science shows this clearly. People often mistake familiarity for understanding. If you hear a concept repeatedly, you begin to feel like you grasp it, even if you've never tested that knowledge or applied it. This is called the fluency effect. It makes people rate their understanding higher than it actually is. As a result, people often make poor decisions with high confidence. They don't second-guess themselves because everything feels familiar. This leads to mistakes that wouldn't occur if they had less information and more humility. This overconfidence isn't just personal. It plays out in institutions and policy decisions as well. A government agency receives more intelligence reports than ever before. Data flows in from satellites, analysts, sensors, and third-party sources. But instead of clarity, this flood of information leads to conflicting signals. Decision-makers rely on fragments they understand, or that support their beliefs. They become overconfident in a flawed interpretation because they're surrounded by data. The sheer weight of information gives them the illusion of thoroughness. But information without structure is just clutter. In teams and organizations, the paradox leads to groupthink. Each person brings in different data points. The group discusses them, and everyone leaves a meeting feeling more informed. But often, instead of challenging assumptions, they align around the most confident speaker or consensus opinion. The illusion of shared knowledge leads to action, but not always to better results. The team believes they've covered the issue because so much was said, yet the most important questions were never asked. The Dunning-Kruger effect also ties into this paradox. People with limited knowledge in a domain tend to overestimate their competence because they don't know what they don't know. They haven't yet learned enough to see the complexity. As knowledge increases, people go through a phase where they lose confidence. They see how much more there is to understand. True experts, oddly enough, are often less confident in their predictions because they're aware of all the variables. In contrast, those with partial knowledge feel emboldened. Think of someone who has just learned about nutrition. They read a few studies and now swear by a specific diet. They become evangelists, convinced they've found the truth. But actual nutrition science is messy. It changes with new evidence. It varies by individual. A trained nutritionist might be cautious and flexible, recognizing exceptions and nuances. But the new enthusiast, armed with limited but loud information, is rigid. More knowledge has made them less open-minded. This paradox plays out in hiring as well. A manager reads multiple resumes, sits through interviews, and uses software to screen candidates. They gather more data than ever before. But the flood of information can lead them to overweight unimportant signals, like the name of a university or how confidently someone answers a question. They may skip the quiet candidate with more substance in favor of the polished speaker who tells them what they want to hear. They feel more confident in their choice, but the data didn't help them make a better decision. Even in everyday life, the knowledge paradox shapes how we see ourselves. People who read widely may begin to see themselves as informed across many subjects. They join debates, take firm positions, and offer advice. But without depth in those areas, their opinions often lack nuance. The illusion of knowledge replaces actual understanding. Meanwhile, the people who know the most, who understand how complex and conditional things really are, often speak more cautiously. They hedge. They explain trade-offs. They sound less certain, even though they're more right. The solution to the knowledge paradox isn't to avoid learning. It's to treat knowledge with humility. More information is only helpful if you understand how to weigh it, question it, and apply it. Otherwise, it's just noise disguised as wisdom. The interest rate paradox. Taking on debt is meant to encourage spending, investing, and hiring. Businesses borrow to expand. Consumers borrow to buy homes and cars. Investors shift money into riskier assets. Lower rates grease the gears of the economy, especially during a slowdown. They act as a lifeline, helping to turn recessions into recoveries. That's the theory. But there's a problem. Cheap money doesn't just support the real economy. It pours into financial markets. It drives up the price of stocks, real estate, and anything else perceived as a store of value. This can inflate dangerous asset bubbles. That's the interest rate paradox. Rates are lowered to boost growth, but those same low rates can distort markets and create new risks. After the 2008 financial crisis, central banks worldwide slashed interest rates. The Federal Reserve dropped its benchmark rate near zero. The goal was clear: stimulate recovery. Jobs had vanished, lending had frozen, and confidence had collapsed. Low rates were intended to restore demand, and they did. Gradually, the economy picked up. But something else happened, too. Stocks entered a historic bull market. Real estate rebounded. Bond yields fell, pushing more investors into equities. Riskier assets surged. This wasn't a coincidence. When safe assets like savings accounts or government bonds offer little return, people search elsewhere. They buy stocks, even if expensive. They invest in real estate, even if yields are low. They chase returns. That demand pushes prices higher, and rising prices draw in more investors, afraid to miss out. The cycle feeds on itself. Markets begin to reflect not just company earnings or property value, but the artificial influence of cheap credit. The real danger is that bubbles often look like success at first. Rising asset prices create a wealth effect. People feel richer. They borrow more. They spend more. This supports short-term growth and reinforces the decision to keep rates low. But beneath the surface, imbalances grow. Leverage increases. Risk tolerance expands. Valuations stretch further from fundamentals. And when the tide turns, when rates rise or confidence cracks, the fall can be sharp. Housing offers a clear example. After 2008, mortgage rates dropped. Monthly payments became more affordable. This helped home buyers and lifted the housing market. But it also sparked speculation. Investors bought second and third homes. Institutional money poured into residential property. In many cities, prices outpaced income growth. Homes became less about shelter and more about investment. When rates rose again, affordability dropped. Activity stalled in some markets. Prices corrected in others. Stocks followed a similar pattern. For over a decade, central banks kept rates low and used quantitative easing to inject more liquidity. That money flowed into markets. Companies with weak fundamentals but compelling narratives attracted capital. Tech stocks soared. Startups raised money at inflated valuations. Retail investors, fueled by zero-commission trading and surging prices, piled in. The market began rewarding momentum over profits. Low rates also distort corporate behavior. When borrowing is cheap, companies issue debt not just for growth, but for stock buybacks. Buybacks reduce the number of shares outstanding, boosting earnings per share, even if actual profit stays flat. This drives stock prices higher and benefits executives with performance-linked pay. But it doesn't necessarily improve the business. It's financial engineering made attractive by cheap credit. Private equity follows suit. When debt is cheap, leveraged buyouts are easier to finance. Firms bid more aggressively. Valuations rise. But the math only works if rates stay low. If they rise, refinancing becomes tougher and exit strategies narrow. What once looked like a great deal becomes a liability. Even venture capital is affected. Low rates make traditional investments less appealing. So speculative tech plays look better. Money pours into startups chasing scale at all costs. Growth before profits becomes a mantra. Companies burn cash to acquire users, delay monetization, and inflate expectations. This can drive innovation, but also hype cycles. Capital chases a few winners and many weak ideas. When rates rise, the dynamic reverses fast. Investors want profits. Startups cut spending. Valuations collapse. Low rates reshape investor psychology. They redefine risk. In a normal environment, a 5% bond looks attractive. In a low-rate world, 5% requires more risk. But the shift isn't obvious. Investors creep into high-yield debt, emerging markets, speculative equities. Portfolio risk increases, but perceived risk doesn't. When volatility returns, losses are worse than expected. People are surprised, not because the assets were inherently dangerous, but because low rates mask the danger. Pension funds and insurers face structural problems. They depend on stable returns to meet long-term obligations. When rates stay low, their models fail. They can't earn enough from bonds. They're forced into riskier or liquid assets. This builds systemic risk. If many institutions are stretched, a shock can ripple through the entire financial system. Central banks know this, but their tools are blunt. Raise rates too soon and growth stalls. Raise them too late and bubbles expand. And once rates are low, they're hard to normalize. Markets get hooked on easy money. Any hint of tightening triggers panic. The 2013 taper tantrum was proof. The Fed merely suggested slowing bond purchases, and global markets recoiled. Investors had become addicted to stimulus. This makes policymaking harder. What's designed to stabilize the economy can destabilize financial markets. That's the paradox. Low rates prevent recessions but can sow the seeds of future instability. The more the economy leans on cheap credit, the harder it is to withdraw that support without triggering a shock. Each cycle of low rates leaves the system more fragile. The interest rate paradox is a warning. Policy decisions have side effects that unfold over time. Stimulus meant to protect today can build risk for tomorrow. Investors, businesses, and governments all respond to incentives, and low rates create powerful ones. They encourage borrowing, leverage, and speculation. And while the first phase feels like prosperity, the second can feel like collapse. The herd behavior paradox. What others buy, they sell. When others sell, they read headlines, glance at charts, and listen to what their peers are doing. Herd behavior isn't just common in markets. It's instinctual. In uncertain environments, doing what the crowd does feels like the safe choice. If everyone else is buying a stock, maybe it's going up. If everyone is selling, maybe they know something you don't. Following the herd feels like self-preservation. But in financial markets, what feels safe often creates the greatest risk. The paradox is simple. Following the crowd offers comfort, but usually leads to bubbles or crashes. Herd behavior stems from how people handle uncertainty. Financial decisions come with incomplete information and risk. Most people aren't reading balance sheets or calculating intrinsic value. Even those who do are still guessing about the future. When faced with doubt, people often use others' behavior as a shortcut. If many investors are buying a stock, real estate, or cryptocurrency, the behavior itself becomes persuasive. The logic goes unspoken. They can't all be wrong. That's how a bubble begins. Early investors buy based on fundamentals or long-term potential. Their buying pushes prices up. Others notice and assume the rising price means value or opportunity. More people jump in, not from deep analysis, but because others already have. The rising price becomes its own justification. As it continues, it draws even more attention. Eventually, prices disconnect from reality. The herd doesn't notice, or doesn't care. Momentum overtakes logic. This played out in the housing market before the 2008 crisis. People kept buying homes because prices were going up. Lenders handed out mortgages freely. Homeowners assumed they could always sell a profit. Construction surged. Speculation exploded. House flipping shows aired in prime time. It felt like a good time to buy because everyone was buying, but beneath the surface, fundamentals were eroding. Prices outpaced incomes. Loans were bundled into complex securities few understood. When defaults began and prices fell, the herd reversed. Everyone rushed to sell. The bubble burst, and the damage went global. A similar pattern defined the dot-com boom of the late 1990s. Tech companies with no profits or even revenue traded at huge valuations. Every day people bought stocks on tips, hunches, and headlines. A company could add .com to its name and double its stock price overnight. Performance didn't matter. Fear of missing out drove demand. No one wanted to be the last to buy. The herd charged in. When it collapsed, trillions vanished. Even smaller events followed this script. In early 2021, the GameStop saga showed how quickly herds can form and how irrational they can become. Retail investors organized online pushed the stock of a struggling company to absurd heights. Some did it to protest Wall Street. Others wanted to ride the wave. Social media amplified the crowd. Bigger, louder, faster. It became less about the company, more about momentum. People bought because others were buying. It worked until it didn't. The stock crashed. Latecomers were left with losses. Herding doesn't just inflate bubbles. It intensifies crashes. In downturns, investors don't calmly assess fundamentals. They watch others. If markets drop 5%, many panic. They sell to avoid more losses, which accelerates the decline. The herd rushes to the exits. Reflex replaces reasoning. Bad news triggers emotional selling. Prices fall too fast. The same people who bought at the top sell at the bottom. The paradox is that acting alone feels risky, but following the crowd is often more dangerous. Independent analysis takes effort and carries the risk of being wrong. Going against a group feels isolating. But in markets, safety in numbers can drive everyone off a cliff together. Herds can't see cliffs, they just move. This behavior isn't limited to retail investors. Institutions and professionals herd too, in more complex ways. Fund managers track benchmarks and peers. If everyone's overweight in a hot sector and you're not, you risk underperforming, which could cost you your job. So you follow. You buy what others buy. Even if you think it's overpriced, you mimic the portfolio. That's called career risk. It's one reason bubbles last longer than they should. It's not that everyone believes in the price. It's that no one wants to admit it's wrong first. Algorithms have their own version of herding. Many trading programs follow similar signals: momentum, volatility triggers, pattern recognition. In a fast market, they may all start buying or selling at once. What looks like individual trades becomes a mass movement. Speed magnifies the effect. The result is a flash crash or runaway rally. Machines don't feel fear, but they still herd. When their inputs align, they mimic human behavior. It's hard to resist the herd. It offers emotional protection. If your investment fails, but everyone else did the same, the loss doesn't sting as much. But if you go against the crowd and fail, it feels personal. That social cost drives conformity. Behavioral finance calls this social proof, the belief that a decision is right because others are making it. But in markets, social proof often leads to collective error. What makes herding dangerous is how fast it feeds on itself. Price gains justify more buying. Price drops justify more selling. Feedback loops form. Investors don't analyze, they react. A 5% rise convinces them it'll rise another 5%. A 5% fall convinces them it'll keep dropping. There's no long-term thinking, only crowd movement. Ironically, many investors say they want to buy low and sell high, but herding makes them do the opposite. They buy high because others are buying. They sell low because others are selling. They follow what feels right in the moment and ignore deeper logic. Markets work best when people think independently. But independence is uncomfortable. It requires accepting that you might be wrong. And alone, herding offers the opposite, the comfort of being wrong together. That's why it's so common, and why it so often ends in disaster. The very thing that makes herding feel safe is what makes it so dangerous. When too many people move in the same direction, the exit becomes too narrow. And when the mood shifts, what once felt like security turns into a stampede. The debt paradox. Debt is one of the oldest tools in finance. It allows people, businesses, and governments to access money they don't yet have in exchange for a promise to repay it later with interest. Done well, debt unlocks opportunity. A worker borrows to buy a car and lands a better job. A business takes out a loan, expands operations, and grows its revenue. A government issues bonds to fund infrastructure, schools, and hospitals. In every case, debt fuels forward motion. Without it, many investments, especially large ones, would never happen. But the same mechanism that builds can also destroy. Take on too much debt, and the burden of repayment crushes growth. Interest payments pile up. Cash gets drained. Defaults rise. The very thing meant to create wealth begins to erode it. This is the debt paradox. Borrowing drives progress until it drives collapse. Start with a household. Most people don't buy homes in cash. Mortgages, long-term debt, make homeownership possible. In theory, the homeowner uses debt to secure a stable place to live, build equity, and eventually own the home outright. If the buyer chooses a reasonable loan, stays within budget, and keeps earning a steady income, the system works. Over 30 years, the loan is paid off, the house appreciates, and wealth is created. But shift the scenario. A borrower takes on too much mortgage debt, assuming housing prices will keep rising. They stretch their income, buy a more expensive house than they can afford, or rely on adjustable rates that balloon over time. If interest rates rise or they lose a job, payments become unmanageable. A few missed months, and foreclosure looms. The dream of homeownership turns into a financial trap. What began as a tool for stability becomes the cause of instability. The 2008 housing crisis illustrates this clearly. Cheap credit, lax lending, and speculative behavior led to a wave of overborrowing. People were encouraged to buy homes with little or no down payment, using loans they didn't fully understand. Banks packaged these loans into complex securities, betting that home prices would always rise. For a few years, it worked. Housing markets boomed, construction flourished, and consumers felt rich. But the debt piled up. When prices flattened and fell, the weight of that debt crushed everything beneath it. Banks collapsed. Families lost homes. Governments intervened to prevent total economic breakdown. Debt is powerful because it brings future money into the present. This gives borrowers a head start, but also locks them into future obligations. When a return on borrowed money exceeds the cost of borrowing, debt builds wealth. But when the cost outpaces a return, debt eats into the very gains it once made possible. That tipping point, where growth turns to collapse, is the heart of the debt paradox. Businesses use debt to finance operations, purchase equipment, or expand into new markets. Corporate debt can increase efficiency and profits if used well. A factory borrows to modernize its production line. A retailer opens new locations. As long as revenue outpaces interest and repayment, the model is sustainable. Investors often reward firms that take on productive debt because it signals confidence and ambition. But like households, businesses can overextend. In good times, they may borrow aggressively, assuming growth will continue. They refinance, restructure, and take advantage of low interest rates. If markets shift or demand falls, those debt payments become a burden. Servicing the debt consumes cash that should go to wages, research, or product development. The company starts cutting. Layoffs follow. Growth stalls. Eventually, if debt becomes unpayable, bankruptcy is the result. Investors lose. Workers suffer. A business once poised for expansion shrinks or disappears. Governments are not immune. Public debt funds roads, defense, pensions, healthcare. When managed responsibly, this debt supports long-term growth. Borrowing during recessions helps stabilize the economy through stimulus spending. Issuing bond allows investment in infrastructure that takes decades to pay off but serves generations. But governments too face the debt paradox. When debt grows faster than the economy, the interest burden begins to choke the budget. Payments on past borrowing crowd out current spending. A larger share of taxes goes to bondholders, not services. In extreme cases, governments must cut benefits, raise taxes, or default altogether. In countries with high sovereign debt, like Greece in the early 2010s, debt ceilings became cliffs. When confidence collapsed, borrowing costs surged. Investors demanded higher yields. Debt became harder to roll over. Austerity was imposed. Services were cut. The economy shrank. Unemployment soared. Debt, once a tool for national investment, became a national crisis. On a global scale, the debt paradox reveals itself in cycles. Periods of easy credit lead to borrowing binges. Households, firms, and governments all spend beyond their means. Debt inflates asset prices. The economy appears strong. But beneath the surface, obligations accumulate. When credit tightens, due to rising interest rates, inflation, or external shocks, those obligations become visible. The cycle reverses. Borrowers rush to deleverage. Spending slows. Defaults spike. A slowdown becomes a recession. The paradox is that debt-fueled growth makes the economy more fragile. What looked like strength was leverage. Central banks try to manage this cycle. They lower interest rates to encourage borrowing in bad times. They raise rates to prevent overheating in good times. But their control is imperfect. Sometimes rates stay low too long. Borrowing becomes excessive. Risk-taking increases. At other times, they tighten too quickly, triggering the very downturn they hope to avoid. Policymakers are always caught between supporting growth and avoiding collapse, between encouraging borrowing and containing its dangers. The paradox plays out in personal finance as well. Credit cards, payday loans, and buy now, pay later services offer access to goods today at the cost of tomorrow's income. Used carefully, credit provides flexibility. Used recklessly, it leads to cycles of debt dependence. A $500 emergency becomes a $$1,000 debt over time. Late fees, compounding interest, and minimum payments trap consumers in long-term obligations that far exceed the original need. The convenience of debt masks its long-term cost. Debt is not inherently bad. It is a neutral tool. In skilled hands, it accelerates growth, funds innovation, and smooths life's uncertainties. But in careless hands, or when overused, it multiplies fragility. The tipping point often isn't obvious. It doesn't arrive with a bang. It builds quietly. Debt levels rise. Interest obligations creep up. Cash flow tightens. The system becomes brittle. A single shock, job loss, rate hike, missed payment, snaps the balance. This is the essence of the debt paradox. What begins as an engine for growth becomes a drag on the future. The more debt fuels expansion, the more sensitive the system becomes to stress. And once momentum shifts, it's hard to reverse. Borrowers must pay down old obligations before they can invest again. Growth slows further. The system enters a negative feedback loop. Understanding the debt paradox means recognizing that more is not always better. Borrowing can be wise. It can also be reckless. Debt is a bet on the future. It assumes stability, growth, and the ability to repay. But the future is unpredictable. The long-term versus short-term paradox. The standard of financial wisdom is clear. Think long-term. It's what seasoned investors recommend, and it's backed by decades of data. Staying invested through market ups and downs leads to better outcomes. Compound growth takes time, and markets tend to reward patience. Yet despite this, most investors behave in ways shaped by short-term noise. They check prices daily, panic during market dips, chase trends, and react to headlines. They say they're in it for the long haul, but act like every week is the end of the game. This is a paradox. Investors claim to think long-term, but their actions are often driven by short-term impulses. It begins with how people experience risk. Long-term investing works best when short-term movements are ignored. But markets are noisy. Prices swing daily. Financial news runs 24/7, and social media amplifies every opinion and prediction. Constant exposure to this stream of information makes it difficult not to react. A portfolio that drops 20% in a month doesn't feel like a small blip in a decades-long plan. It feels like something is wrong. Emotion kicks in. Sell before it gets worse. Consider a retirement investor with a 30-year horizon. They hold a diversified index fund, a strategy that has historically delivered reliable returns over time. The plan is to invest consistently and ignore short-term fluctuations. But then, a year into the plan, a recession hits. Markets drop 25%, headlines scream financial crisis, and the investor's portfolio value plunges. Doubts creep in. What if this time is different? The plan was long-term, but the reaction is short-term. They sell. This kind of behavior is common. Data from brokerage platforms shows that most individual investors underperform the very funds they invest in. The problem isn't the funds, it's the timing. Investors jump in after prices rise and bail out after they fall. They try to time the market, responding to short-term movements even as they claim to be long-term thinkers. The paradox is reinforced by the structure of the financial industry. Fund managers are evaluated on quarterly performance, underperform for a few quarters, and they risk losing clients or their jobs. This pressure drives short-term decision-making, even when a longer-term view would be wiser. Media also plays a role. Financial news thrives not on long-term thinking, but on drama, volatility, and urgency. Stay the course for 20 years doesn't get clicks. Market crash incoming does. Even the tools investors use encourage short-term thinking. Mobile trading apps put real-time market data at your fingertips. You can watch your net worth change minute by minute. The easier it is to check, the harder it is to ignore. Instant access increases anxiety. Investors become focused on today's numbers rather than tomorrow's potential. There's a psychological layer too. Long-term goals like retirement or college funds are abstract and distant, but a market loss today is tangible and painful. Behavioral finance calls this loss aversion. Losses feel more intense and equivalent gains feel good. So when the market drops 10%, investors feel compelled to act. Even when the best move is often to do nothing, markets themselves reflect this tension. In the short term, prices are driven by emotion, news, and speculation. In the long term, they reflect fundamentals like earnings and economic growth. A stock can fall on rumor despite strong fundamentals, or soar on hype despite poor performance. The short-term investor sees noise. The long-term investor sees value. Warren Buffett has addressed this paradox many times. He says the market is designed to transfer wealth from the impatient to the patient. But patience is hard. It means watching your investments decline without flinching. It means holding steady while others chase the latest hot trend. It means sticking with a strategy even when it feels uncomfortable. Most people know this logically, but emotionally, they struggle. A vivid example came during the 2020 pandemic. In March, markets crashed. Investors fled to safety. Some sold at the bottom. But just a few months later, markets had rebounded. By year's end, many indexes were hitting new highs. Those who stayed invested saw recovery. Those who sold locked in losses. The crisis exposed who truly had a long-term mindset and who merely said they did. Another aspect of the paradox is how people define long-term. For some, it means 3 years. For others, 30. True long-term investing means decades. It means accepting that your portfolio will sometimes decline. It means anticipating recessions, corrections, and panics, not as surprises, but as inevitable parts of the journey. And it means being prepared emotionally and financially. Resolving the paradox takes discipline. One effective method is automation. Set up regular contributions and avoid checking your account too often. This reduces emotional interference. Another is aligning your investments with your time horizon. Money needed in the short term shouldn't be in volatile assets. This buffer helps you avoid disrupting long-term plans when short-term needs arise. Investors can also benefit from reframing how they view volatility. Downturns aren't threats, they're expected. Every long-term chart includes major drops, but over time, the trend is upward. Staying invested during rough periods is what generates long-term wealth. Ultimately, the long-term versus short-term paradox is a behavioral issue. Most people understand the right strategy. Buy good assets, hold them, don't panic. But instincts push them to do the opposite. They crave action, fear loss, and react to noise, undermining their own goals. To succeed as an investor, it's not enough to choose a smart strategy. You must also resist the urge to abandon it when markets get loud. The buy and hold paradox. One of the most praised investment strategies is simple. You pick quality assets, usually broad index funds or strong individual stocks, and hold them for the long term. You don't time the market. You don't jump in and out. You just stay the course. Over decades, the historical data supports it. Markets tend to go up over time. Compound growth does the heavy lifting. Transaction fees are minimized. Taxes are deferred. Volatility gets smoothed out. The longer the timeline, the more buy and hold seems unbeatable. But there's a catch that doesn't show up in charts or backtests. You actually have to hold through everything. And that's where most investors break. The buy and hold paradox is that the strategy works on paper, but most people can't follow through when it matters most. It's not hard to buy. It's not even hard to hold when times are good. The real test comes during brutal downturns, when everything in you screams to sell. The numbers drop. The news turns dark. Your portfolio bleeds red. In those moments, the plan feels foolish. You tell yourself, this time might be different. Holding doesn't feel like discipline. It feels like denial. Consider the 2008 financial crisis. The S&P 500 lost more than 50% from its peak over about 17 months. The market plunged. Lehman Brothers collapsed. Banks failed. Real estate crashed. Headlines warned of another Great Depression. In that environment, holding a stock portfolio didn't feel brave. It felt reckless. Investors who stuck to buy and hold saw their wealth cut in half. For many, that was too much. They bailed out. They sold at the bottom. They missed the recovery. Those who truly held, without selling, without hedging, without flinching, eventually came out ahead. The market recovered. Dividends resumed. Compound interest kicked back in. But to get there, they had to endure panic, doubt, and the appearance of ruin. The strategy worked, but it demanded something most people couldn't give: emotional resilience under fire. A similar story unfolded during the COVID-19 crash in early 2020. The market fell 30% in about a month. That speed was terrifying. Travel stopped. Cities shut down. The economy stalled. Investors faced a fast, steep drop with no clear sense of how bad things would get. Some sold early. Others sold at the bottom. But the market snapped back almost as fast as it fell. Those who sold had to decide when to get back in, and most didn't do it in time to catch the recovery. Once again, buy and hold worked. For those who could actually hold, the paradox is amplified by how we experience loss. Losses hurt more than gains feel good. This isn't theory. It's behavioral psychology. A 30% drop in your portfolio doesn't just register as a financial event. It feels like failure. It causes stress. When it happens quickly, it creates panic. Investors in those moments aren't thinking about 30-year charts. They're thinking about the money they might never get back, the plans they'll have to delay, the safety they thought they had but don't feel anymore. Buy and hold requires investors to do the opposite of what their emotions tell them. It asks for conviction when doubt is everywhere. It asks for calm in the middle of chaos. It asks for faith in a future that seems uncertain. That's why the strategy works, because it's hard. The rewards come to those who can wait, but more importantly, to those who can endure. It also asks for a level of financial stability that not everyone has. Holding through a downturn is easier when you don't need to sell. If your job is secure, your bills are covered, and your emergency fund is full, then a bear market is a paper loss. But if you lose your income or face unexpected expenses, you might be forced to sell at the worst time, not because of panic, but because of necessity. That's not an emotional failure. It's a structural risk. It shows that buy and hold also depends on external stability, not just internal discipline. Even among those who do have the ability to hold, few prepare for the pain of it. They read about 7% average returns and assume the path will be smooth. They imagine compounding like a staircase. But the market doesn't move like that. It surges. It stalls. It crashes. It recovers. Then it repeats. It tests conviction. Long-term investors are guaranteed to face multiple bear markets. Each one will feel like it might be the last. Each one will come with headlines saying, "This time is different." And each time, the right move will still be to hold, if the underlying strategy and holdings remain sound. Buy and hold also becomes more difficult in a culture of immediacy. We're trained to expect quick results. News cycles are fast. Social media amplifies every dip and spike. We check our accounts daily, even when we say we're long-term investors. Every small loss becomes a signal. Every headline adds a noise. In that environment, holding for decades requires not just strategy, but silence, an ability to tune out short-term distractions and remember the actual timeline you committed to. That timeline matters. Buy and hold only works if you give it time. If you plan to hold for 5 years, you're not really using the strategy. That's still within the window of short-term market cycles. Real buy and hold is 10, 20, 30 years. It's a strategy for retirement accounts, for legacy planning, for building generational wealth. And that long arc makes a downturn survivable. Over 30 years, even a 50% crash is a dip, not a disaster. But over 3 years, it feels like catastrophe. Most investors think they're long-term until the short-term pain shows up. Time is what makes the strategy work. But time alone isn't enough. You need the psychological strength to stick with it. That's the hidden cost of buy and hold. It's not about intellect. It's not about financial modeling. It's about temperament. It rewards those who can delay gratification, withstand discomfort, and ignore the herd. And even then, the paradox stays sharp. The more you know how well buy and hold works, the harder it becomes to watch others succeed with risky trades in the short term. When a meme stock doubles overnight or a speculative bet pays off, long-term investors can feel left behind. The slow, steady path seems boring, but that boredom is a feature, not a flaw. Long-term wealth is built slowly. It doesn't make headlines. It doesn't spike. But it does endure if you can hold. The strategy is simple. Execution is not. Buy and hold isn't about buying at the right time. It's about not selling at the wrong time. That's what most people fail to do. That's why the strategy works. But only for those who stay. Every investor wants alpha. It means outperforming the market. The liquidity paradox. Managing your finances with liquidity in mind allows you to respond quickly to opportunities or emergencies whether it's making purchases, investing, or covering unexpected expenses without having to sell off assets or take on debt. Cash, in theory, offers comfort due to its accessibility, stability, and freedom from the volatility of investments like stocks or real estate. However, its very strength becomes its weakness over time. Inflation steadily erodes the value of money, meaning that holding large amount of cash for long periods leads to a gradual loss of purchasing power. This creates what is often referred to as a cash paradox. While cash grants short-term flexibility, it guarantees a silent, long-term decline in value. The first layer of this paradox is straightforward. Cash does not keep up with inflation. Inflation, the steady rise in prices for goods and services, reduces the value of money over time. Even in stable economies, inflation may range from 1% to 3% annually. For example, if you hold $100 and inflation is 2%, that same money will buy only $98 worth of goods a year later. The longer you hold on to that cash without it earning significant interest or being invested, the more value it loses in real terms. This loss becomes especially severe during periods of high inflation or economic instability. Take the 1970s in the United States, for instance, when inflation rates exceeded 10% in some years. A person holding $1,000 in cash could lose over $100 in purchasing power annually. In such environments, cash is not a safe haven. It becomes a depreciating asset. The second layer of the paradox lies in opportunity cost. Holding cash often means missing out on the potential gains that other assets can offer. While savings accounts might earn a minimal interest rate, say 0.5% annually, inflation could be rising at 2%, resulting in a net loss of purchasing power. For example, if you have $10,000 in a low-interest account, you might earn $50 in interest over a year, but inflation would reduce the real value of that money by $200. In contrast, investments such as stocks, bonds, or real estate have historically offered higher returns that tend to outpace inflation over time, providing both growth and preservation of value. Moreover, holding large amounts of idle cash contributes to long-term financial stagnation. Individuals and businesses that consistently hold onto cash rather than investing it limit their ability to build wealth. As inflation compounds, the gap between cash and productive assets widens. In the worst-case scenario, a risk-averse saver may find themselves poorer over time than someone who chose to invest, even if the investments came with short-term volatility. Psychologically, cash provides a sense of safety, particularly during economic downturns or market volatility. This is understandable. In times of crisis, people tend to move toward what feels most secure, and cash often fills that role. However, this behavior can backfire. Investors who flee to cash during a downturn may miss the rebound, which is often when the most substantial gains occur. Historically, some of the most successful investors have built their fortunes by investing in undervalued assets during periods of economic distress, not by sitting on the sidelines. The paradox also plays out on a systemic level. Central banks, which control national monetary policy, recognize the danger of too much cash hoarding in the economy. To counter this, they often reduce interest rates or increase the money supply to encourage spending and investment. These actions are designed to create a moderate level of inflation, which stimulates economic activity. But when inflation rises too quickly, it reduces the purchasing power of money, making life more expensive and destabilizing for individuals and businesses alike. On a personal level, this underscores the importance of finding the right balance. Liquidity is essential for handling immediate needs and seizing time-sensitive opportunities. However, holding excessive cash for too long is costly. Inflation is a constant force, and over time it will chip away at unproductive savings. The key is to treat cash as a short-term liquidity tool rather than a long-term store of wealth. For individuals with significant cash reserves, it's crucial to evaluate how much is truly needed for flexibility and how much could be working harder in investments that provide returns above inflation. While there's merit in staying cautious during uncertainty, caution itself can become a form of risk. Over time, uninvested cash guarantees a loss in purchasing power. In contrast, diversified investments, while not without short-term risks, offer a much stronger chance of preserving and growing wealth in the long term. The volatility paradox. In finance, volatility is often viewed as a measure of risk. The common belief is that high volatility equates to high risk, shaping how investors behave in the market. When volatility rises, they tend to act with caution. When it's low, they are more likely to take risks. The volatility paradox arises when periods of low volatility are followed by sudden spikes. In other words, calm markets today can hide the risk of turbulence tomorrow. This paradox stems from behavior of markets during low volatility phases. In such times, asset prices move within a narrow range, and there's a widespread perception of stability. Investors may then feel more secure, prompting them to take on more risk, borrow more, or speculate more aggressively. This behavior can inflate asset prices and amplify financial imbalances. The illusion of safety encourages actions that, over time, build hidden vulnerabilities into the system. But markets are cyclical. Extended periods of calm often precede sharp reversals. Low volatility usually means there are few disruptions or surprises. However, this stability allows risks to accumulate unnoticed. Eventually, some catalyst, such as new economic data, a geopolitical crisis, or an unexpected financial shock, breaks the calm and triggers a surge in volatility. A useful metaphor is a pressure cooker. From the outside, it may seem still, but internal pressure continues to build. When released, it erupts suddenly and powerfully. The 2008 financial crisis illustrates this paradox. In the years before the crash, markets were relatively calm. The housing market was booming, optimism was widespread, and borrowing was easy. But beneath the surface, risks were escalating. Housing prices were unsustainable, and risky mortgage-backed securities were traded freely. When the housing bubble burst, volatility exploded, and the crisis unfolded rapidly. The prior calm had made markets more vulnerable. Another example can be seen in post-crash recovery periods. After major market downturns, volatility tends to decline. This drop can lull investors into a false sense of security, leading them to re-enter the market more aggressively. But this confidence, if premature, can again set the stage for renewed instability. After the dot-com bubble burst in the early 2000s, markets enjoyed a period of apparent stability. Yet by 2007-2008, the global economy plunged into another crisis, reigniting extreme volatility. At its core, the volatility paradox reflects how markets process information. In quiet times, it's easy to assume that all relevant information is already priced in, leading to complacency. But when new, unexpected data emerges, especially if it challenges market assumptions, it can cause sharp, synchronized reactions. The result: rapid market movements as investors rush to adjust. This cycle isn't limited to financial markets. Industries and economies also experience it. Periods of growth and stability often lead businesses to overlook or underestimate disruptive forces, such as changes in consumer behavior, regulation, or technology. The tech sector is a prime example. After stretches of smooth expansion, unexpected innovations or shift in demand can cause dramatic upheaval. Understanding the volatility paradox is essential for risk management. Investors who ignore it may become overconfident during calm periods, increasing their exposure to high-risk assets. When volatility spikes, they can suffer large losses. In contrast, those who acknowledge the paradox are more cautious during quiet times. They may choose to diversify or hedge, recognizing that the calm may be temporary. The paradox also highlights the importance of long-term thinking. While many investors react to short-term market fluctuations, those who take a broader perspective, staying diversified and avoiding impulsive decisions, are often better equipped to handle volatility. Recognizing that market calm doesn't mean risk is gone can help avoid emotional and costly mistakes. Ultimately, the volatility paradox reveals the unpredictable nature of markets. While low volatility may feel reassuring, it can conceal the conditions for future disruption. By understanding its cyclical nature, investors can prepare more strategically, using calm periods not as a signal of safety, but as an opportunity to manage risk before the next storm arrives. The leverage paradox. Portfolios built on simple investing strategies often outperform complex ones. They're backed by data, easy to understand, and effective over time. Buy a low-cost index fund, reinvest the dividends, Hold it for decades, avoid market timing, and stay diversified. That plan consistently beats most active funds, most stock pickers, and most traders. And it's not even close. Yet most investors don't follow it. They chase complexity instead. They look for secret formulas, algorithms, expert insight, or market predictions. They dismiss the simple plan in favor of something that feels smarter. That's the simplicity paradox. Simple strategies work, but people crave complexity. It begins with a basic human instinct. We associate complexity with intelligence. A model with more variables must be more advanced. A portfolio with more holdings must be safer. A strategy using sophisticated math must be more reliable. In daily life, complexity often signals expertise. A detailed medical diagnosis sounds more authoritative than a basic one. A lengthy legal explanation feels more convincing than a brief summary. This instinct spills into finance. Investors want to believe that something complicated offers an edge. But markets don't reward complexity the way people expect. Markets are noisy, adaptive, and heavily influenced by human behavior. They punish overconfidence. The more moving parts a strategy has, the more ways it can break. Assumptions can fail, timing can go wrong, inputs can grow irrelevant, and when the market shifts, as it always does, the complex model often fails. Meanwhile, simple strategies keep working. They don't try to predict, they just participate. Take dollar cost averaging. You invest the same amount of money regularly, regardless of market conditions. You don't try to buy low or sell high. You buy consistently through highs and lows. This approach averages out volatility over time, builds wealth, and doesn't require forecasts, technical analysis, or deep research. Yet it's often dismissed as too basic or boring. The same goes for index investing. Buying a total market or S&P 500 fund gives you broad exposure to hundreds of companies. It costs almost nothing. It requires no constant monitoring or insider knowledge. And over decades, research shows that passive index funds outperform most actively managed funds, especially after accounting for fees. Still, investors continue to pour money into high-fee funds and hedge funds, assuming complexity equals control. It doesn't. It just adds more points of failure. Active management also feeds the ego. It lets investors believe they're in control, that they can spot trends early, that their insights matter, and sometimes they do, but consistently beating the market is rare. It takes skill, discipline, and luck. Most investors, retail and professional, underperform in the long run, but they keep trying. Complexity gives the illusion of power. This desire for complex answers extends beyond investing into financial planning. People seek exotic insurance products, custom tax strategies, and intricate retirement plans that sound advanced. But the best advice remains simple. Spend less than you earn. Save early, stay insured, avoid debt, invest steadily, don't panic. It works, but it sounds too plain. So people turn to expensive advisors, seminars, or multi-step systems, and often end up worse off. Part of the problem is boredom. Simple strategies don't change much. They don't give people anything to tweak or optimize. But investors want to feel involved. They want to act. They check the news, watch the markets, and make small trades. Yet every action carries risk. Every decision is a chance to get it wrong. Simple strategies avoid this by minimizing decisions. They succeed not through precision, but through consistency. There's also social pressure. Simplicity doesn't impress. Saying, I own an index fund, doesn't turn heads. Saying, I trade momentum ETFs and hedge volatility with options, does, even if it underperforms. Complexity sounds smart. Simplicity sounds lazy. So people add layers, create narratives, and make investing harder than it needs to be. Professionals aren't immune. Advisors and portfolio managers must justify their fees. If they recommend a plain index fund and do nothing, clients might question their value. So they complicate. They add asset classes, recommend alternatives, rebalance frequently, and forecast market cycles. It creates the appearance of value, even when returns fall short of a simple benchmark. Backtesting adds another layer to the paradox. Many complex strategies look brilliant in hindsight. They use historical data to build intricate rules, Buy when this crosses at sell on this signal. Rotate sectors quarterly. The charts look clean. The returns look high. But most fail in real time. They're overfit to the past. They capture patterns that no longer apply. The complexity wasn't insight. It was data mining. In contrast, simple strategies endure. A 60-40 stock bond portfolio. A target date retirement fund. A steady savings plan. These don't promise to beat the market, but they keep people invested. They avoid catastrophic errors. And over time, they often outperform the complex approaches that chase every signal. Simplicity trades the hope of outperformance for the reality of staying invested. That trade usually wins. Some of the most successful investors understand this. Warren Buffett recommends index funds for most people. Jack Bogle built Vanguard on the idea that low-cost simplicity beats high-cost complexity. Even Ray Dalio, famous for intricate macro strategies, emphasizes timeless principles like diversification and discipline. The best don't chase complexity for its own sake. They use it only when it adds real value. Behavioral finance helps explain why people ignore this. Humans are overconfident. They think they're above average. They look for patterns in noise. They believe more information leads to better outcomes. But in investing, more data often means more distractions. Simpler strategies avoid this. They cut decisions, reduce emotion, and build consistency. That discipline adds more value than most complex analysis ever could. The problem is, simplicity doesn't sell. It doesn't make headlines. It doesn't create buzz. Complexity excites. It gives people something to do, something to buy, something to believe in. The financial industry is built on that desire, and that's the paradox. The strategy that works best is the one most people ignore because it looks too easy. The rational market paradox. Markets are supposed to be built on rational decisions, buyers and sellers weighing facts, considering risks, and acting to maximize value. This assumption underlies many financial models. Prices reflect all available information, supply meets demand, and investors act logically. But anyone who has watched markets in real time knows this isn't how things actually work. Prices swing wildly. People chase trends. Bubbles form and burst. This is a paradox. Markets are thought to be driven by reason, but they often behave like emotional crowds. The theory assumes that if a company's profits go up, its stock price should rise. If bad news emerges, the price should fall. But in reality, markets rarely follow such clean, logical patterns. What moves markets is not just data, it's emotion. Fear, greed, and the fear of missing out, FOMO, can be as influential as earnings reports or interest rate announcements. During times of panic, rational thought often vanishes. Investors sell not because the fundamentals have changed, but because they're afraid others will sell first. Fear spreads and prices drop, not gradually, but in sudden cascading waves. The COVID-19 crash of 2020 is a striking example. In mere days, markets lost trillions of dollars. Most investors weren't reacting to a detailed economic forecast. They were reacting to headlines, uncertainty, and a desire to exit before the fall got worse. On the flip side, greed fuels rallies. When markets are rising, caution is often thrown aside. Instead of asking whether an asset is overvalued, investors ask how much higher it can go. People buy in not after careful analysis, but because others are making money. That's how bubbles form. In the late 1990s, tech stocks soared, even those from companies with no profits or sustainable business plans. The logic became circular. Prices were rising, so people assumed the stocks were worth buying. When the bubble burst, emotions gave way to reality and prices crashed. FOMO is subtler but just as irrational. It doesn't stem directly from fear or greed, but from the discomfort of being left behind. It drives people to buy at the peak because friends have already made money. It pushes investors to chase trends in meme stocks or cryptocurrencies, even when they know the fundamentals don't justify the price. FOMO isn't driven by analysis. It's driven by anxiety, envy, and the fear of missing an opportunity. These behaviors aren't limited to amateur investors. Professional fund managers face pressure too. They're judged by performance, and if they lag behind during a rally, clients may pull their money. This creates strong incentives to follow the herd. Even cautious managers end up buying overhyped assets, not because fundamentals support the move, but because they can't afford to miss out. One of the clearest illustrations of this paradox came during the 2021 GameStop saga. A group of retail investors on Reddit coordinated to drive up the stock price of a struggling company, partly to punish short sellers. The stock surged far beyond what the company's fundamentals could justify. Some joined in as an act of rebellion. Others because the stock kept going up. It was less about financial value and more about group identity and momentum. Traditional models couldn't explain the price. It wasn't about discounted cash flows. It was about collective sentiment and viral energy. Even market reactions to news often defy rational logic. A company may report strong earnings, yet its stock falls because the results didn't meet overblown expectations. Another company might announce layoffs, and its stock rises because investors expect cost savings. These reactions don't always make logical sense. They're filtered through narratives, expectations, and perceptions of how others will react. Behavioral economics has spent decades studying these deviations from rationality. People anchor on past prices. They overreact to news. They fear losses more than they value gains. They seek confirmation of existing beliefs and dismiss contradictory evidence. When these biases play out across millions of investors, they influence prices. Markets reflect not just facts, but flawed human psychology on a grand scale. Technology hasn't eliminated this problem. Sometimes it amplifies it. Algorithmic trading systems react to price movements and volatility thresholds. When markets shift, these systems can all respond at once, accelerating trends. Small moves become big ones, not because of new data, but because automated systems pile on in a feedback loop. Humans built these systems, and human flaws are still embedded in their logic. The idea that markets are rational is useful. It allows economists to create models, run simulations, and make predictions. But these models often fail when they're needed most, during crashes, bubbles, or periods of uncertainty. The rational market paradox reminds us that while prices may contain information, they also contain emotion. Prices reflect how people feel about information and how they expect others to feel. If markets were truly rational, there would be no bubbles or crashes, just smooth, logical adjustments to new data. But history tells a different story. The Dutch tulip mania, the South Sea bubble, the roaring 20s, the dot-com boom, the housing crash. Over and over, people believe good times will last forever. They ignore warnings, follow the crowd, and then suffer when the correction comes. Belief in rational markets can even encourage risky behavior. If prices are always right, then why question them? This leads to complacency. But if markets are being driven by emotion more than data, that assumption becomes dangerous. Markets are not machines. They are crowds. Crowds made up of people with diverse goals, different levels of knowledge, and varying emotional triggers. Some are cautious, others impulsive. Some think long-term, others chase short-term gains. The resulting prices are not just summaries of data, but snapshots of crowd psychology. Understanding the rational market paradox doesn't mean abandoning logic or ignoring data. It means acknowledging that real-world markets are shaped by how real people behave, sometimes rationally, often emotionally. Even the best information can be drowned out by fear, greed, or hype. What looks logical from a distance often turns out to be chaos up close. The active versus passive paradox. It's simple, low cost, and backed by decades of data. Passive investing often outperforms active strategies over the long run. Instead of trying to pick individual stocks or time the market, passive investors buy broad market indexes like the S&P 500 or total market funds and hold them. These indexes capture performance of large segments of the economy, helping investors avoid high fees, reduce trading, and benefit from long-term market growth. It seems like the perfect solution, but there's a catch. Passive investing relies entirely on the actions of active investors to function. That's the heart of the paradox. Passive strategies beat active ones over time, but only because active investors are still doing the hard work of pricing stocks. To understand this, you have to look at how passive investing actually works. An index fund doesn't try to decide whether one company is a better investment than another. It simply buys stocks in the proportions dictated by the index. If the S&P 500 includes Apple at 6% and Microsoft at 5%, the fund buys those stocks in those ratios. The fund manager doesn't evaluate prices. They just accept them. That's the core principle of passive investing. Accept the market as it is. But the market isn't static. Prices change constantly as new information emerges. A company beats earnings expectations. Its stock rises. A CEO resigns under scandal. The stock drops. These changes don't come from passive funds. They're driven by active investors, analysts, hedge funds, institutions, and traders who study companies, form opinions, and make trades. These are the price setters. Without active investors, there would be no mechanism to adjust prices in response to new data. The market will become inefficient. Poor companies could stay overvalued, strong ones undervalued. Passive investing assumes prices are already accurate, that markets have incorporated all available information. But it's active investors who make that assumption valid. They're buying and selling move prices, keeping the market efficient. Passive investors, by definition, are just along for the ride. This creates a strange dynamic. Passive investors rely on active investors to keep markets functioning. If everyone went passive, the market would stop processing information. Prices would no longer reflect fundamentals. The very thing that makes passive investing work, the belief in accurate pricing, would collapse. That's what makes passive investing both powerful and fragile. It succeeds only because others are still doing the work it avoids. Consider what happens when a company goes public. Active investors analyze it, assess its value, and decide whether to buy at the IPO price. They compare to competitors, scrutinize financials, and estimate its future. Passive investors don't get involved until the company joins an index. By then, its price has already been shaped by active decision-making. The passive investor simply accepts the outcome. This relationship becomes even more evident during major events, a recession, a crisis, a geopolitical shock. Active investors respond to the new reality. They reassess risk, sell overvalued assets, and buy undervalued ones. Their trades help the market find a new equilibrium. Passive funds don't react. They hold their positions, unchanged by the world around them. They don't adjust, they reflect. The paradox deepens as passive investing grows. Decades ago, it was a niche strategy. Most people used actively managed mutual funds. But as studies showed most active managers underperform over time, investors shifted to index funds. Today, passive strategies control over half of U.S. equity assets, and that number continues to rise. The question grows louder. What happens if too few active investors remain to keep markets efficient? There's no easy answer. In theory, as active investors become fewer, their influence increases. With less competition, they may find more profitable opportunities, encouraging others to become active again. This could restore balance. The market might oscillate between active and passive in a self-regulating cycle. But it also means the success of passive investing is not guaranteed. It depends on an efficient market, and efficiency depends on people actively discovering prices. There are other risks. Index funds buy based on size, not merit. The largest companies get the most investment, which pushes their prices up. This can create a momentum effect. Companies grow in value not because they're better, but because they're bigger. A feedback loop forms. If unchecked, it distorts the market, driving prices higher without reflecting reality. In a rational market, active investors would correct this, betting against overvalued giants. But if there are too few active traders, those corrections may not happen. Passive investing, left alone, could misallocate capital. It could reward companies simply for being in an index, not for being good investments. Passive investors also tend not to engage deeply in corporate governance. Shareholders play a role in holding management accountable, voting on board decisions, pushing for transparency, and demanding performance. Active investors often take this seriously. Passive funds usually don't. They vote, but they don't analyze or advocate in the same way. As passive ownership grows, fewer shareholders are watching closely. This weakens oversight and reduces pressure on companies to act responsibly. Despite these vulnerabilities, passive investing continues to dominate. It's cheaper, simpler, and statistically, it works. For most people, Buying a broad market index and holding it is more effective than trying to beat the market. Over long periods, passive strategies outperform the majority of active ones. Fees are lower, turnover is minimal, and returns align with overall market performance. But those results hinge on something many passive investors forget: the work of others. Their success depends on prices that were discovered, debated, and decided by active participants. Passive investing doesn't drive markets. It rides them. That's the paradox. Passive wins, but only because active is still in the game. When markets move, people don't move alone. They follow each other. They buy. They sell. They react to the world. And while passive investing may look effortless on the surface, it's built on a foundation of effort. Effort from those who are still paying attention. The alpha paradox. Beating the benchmark, doing better than the average, is the goal behind most active strategies. Fund managers chase it. Hedge funds market it. Individual investors hope for it. Alpha is a prize for being right when others are wrong, for spotting what others miss, for taking smart risks and reaping the reward. But here's the problem. The market is made up of investors. It's not some external machine to be outwitted. It's the sum of all participants. And most people, by definition, can't beat the average. For every investor who earns alpha, another must fall behind. That's the alpha paradox. Everyone wants to outperform, but together, they are the market. The average returns the benchmark, and not everyone can be above average. This truth is uncomfortable, especially for professionals. If a mutual fund manager earns 2% above the S&P 500, someone else must underperform by 2% to keep the system balanced. The stock market doesn't generate alpha on its own. It generates returns. Alpha is relative. It's performance above the average. So for one investor to gain an edge, another must unknowingly give one up. This becomes even clearer when you consider fees. Active managers charge more, and that higher cost has to be justified by better results. But over time, the data shows that most active funds don't outperform their benchmarks after fees. Some do, particularly in short bursts. But over 10 or 20 years, the majority fall short. The SPIVA, S&P indices versus active, reports confirm this repeatedly. A small group of managers outperform consistently, but they're rare and their identities often shift. Yesterday's winners don't stay winners. For the average investor, this means chasing alpha often ends in disappointment. You're not just trying to beat the market. You're trying to beat other investors. Many of them have better tools, faster access to information, and more experience. They're not guessing. They're pricing in every signal, every piece of news. By the time you act on a headline, it's already in the price. The edge is gone. Alpha exists, but it's scarce and unevenly distributed. Some investors earn it through early insight, deep research, or behavioral discipline, doing the right thing when others panic. But for everyone who finds real alpha, many more believe they have it and don't. The market humbles them. Consider a simple case. Imagine 10 investors, each convinced they can beat the market. Each has a strategy, a thesis, a reason to believe. But only one can be at the top. If 3 beat the average, the other 7 must lag behind. That's the math. The group as a whole is the average. No amount of ambition changes that. The market is a zero-sum game before costs and a negative-sum game after costs. This paradox gets obscured in bull markets, when almost everyone is making money. It's easy to feel like you're doing well. If your portfolio is up 12% and the S&P is up 10%, you celebrate. But if the S&P is up 25% and you're up 12%, it feels like failure, even though you made money. That's alpha. It's not about gains, it's about relative gains. This mindset can lead to trouble. In pursuit of alpha, investors often take on risks they don't understand. They chase hot sectors, jump between strategies, and follow tips and stories. The desire to win leads to decisions that unravel when markets turn. Ironically, try and beat the market often leads to underperformance. The more aggressively you chase alpha, the harder it becomes to catch. That's part of why passive investing has grown. If most active strategies fail after fees, then the rational move is to accept the market return. Index funds don't seek alpha, they mirror the benchmark. And over time, They often outperform most active funds, not because they're clever, but because they're cheap, consistent, and immune to behavioral pitfalls. Passive investors aren't trying to win. They're trying not to lose. And that turns out to be a better long-term strategy for most people. Still, alpha remains alluring. Investors don't just want average. They want to be above average. They want to win. It's not just a financial goal. It's an emotional one. That's why new funds, new strategies, and fresh promises of outperformance continue to appear. But the paradox stays. Everyone can't be above average. For someone to get alpha, someone else has to miss it. The more people hunt for it, the harder it is to find. When alpha does show up, it often doesn't look like brilliance in the moment. It can come from patience during drawdowns, from avoiding fads, from buying when others are fearful and holding when others are greedy. These aren't flashy moves. They're quiet. They often require doing nothing when everyone else is doing something. But that's where long-term edge lives, not in prediction, but in discipline. The alpha paradox should humble investors. It doesn't mean you shouldn't try to improve your results, but it does mean you should understand the odds. Alpha is rare. The market is efficient enough that easy wins are rare. Most of the time, your returns will mirror the market's minus costs, mistakes, and emotions. The more you accept that, the clearer your definition of success can become. Chasing alpha is less about skill and more about self-awareness, knowing when not to act, knowing when to stay the course, knowing that trying to beat the market every day usually ends in beating yourself. The alpha paradox reminds us that in a market made of people who want to win, most won't. The ones who do are exceptions. The rest are the market. And when something is rare, it's only natural that everyone wants it, even if few ever truly find it. The market efficiency paradox. For decades, finance has been shaped by the efficient market hypothesis, EMH, which claims that financial markets are informationally efficient. This means that at any given time, asset prices fully reflect all available information. If this theory holds true, it implies that it is essentially impossible for investors to consistently outperform the market through strategies such as stock picking or market timing. In an efficient market, there is no edge because all relevant information is already factored into prices. However, this leads to a paradox. While EMH suggests that trying to beat the market is futile, investors continue to attempt it every day. Ironically, their very efforts to outperform a market are what help maintain its efficiency. This is the heart of the market efficiency paradox. Those attempting to exploit inefficiencies are the ones who help eliminate them. The first part of the paradox is rooted in the idea that in a truly efficient market, consistent outperformance is nearly impossible, especially after accounting for transaction costs. EMH posits that all publicly available information is immediately incorporated into asset prices. For example, if a company announces strong earnings, its stock price should instantly rise to reflect the news. Therefore, there should be no window for investors to act on that information before the price adjusts. In such a scenario, it becomes extremely difficult to find undervalued or overvalued stocks because prices already embody all known information. Despite this, countless investors, individuals, fund managers, and even algorithmic systems engage in the relentless pursuit of market-beating returns. They rely on tools like technical analysis, fundamental analysis, and quantitative models to identify mispriced assets, anticipate trends, or time their trades. The surprising result of these efforts is that they contribute to the market's overall efficiency. When investors identify what they believe to be undervalued assets and purchase them, they increase demand and help push prices toward their fair value. Similarly, selling overvalued assets exerts downward pressure, aligning prices with fundamentals. This continuous process of analysis and trading forms a self-correcting cycle. As more investors attempt to beat the market, asset prices adjust more quickly and accurately. This leaves even fewer opportunities for excess returns. The very act of trying to outsmart the market reduces the chances of doing so, reinforcing the paradox. The paradox becomes more pronounced when considering the number of participants trying to outperform the market. If everyone simply accepted EMH and invested passively in broad market indices, efficiency might theoretically be achieved more rapidly. However, most investors remain convinced that they can find an edge, even though studies show that the majority of active managers fail to beat the market over time. This constant flow of buying and selling, driven by the belief that exploitable opportunities exist, ensures that prices reflect information more swiftly. Ironically, these efforts make the market more difficult to outperform. As soon as a mispricing is discovered and acted upon, it vanishes. In this way, the pursuit of superior returns ultimately strengthens the very mechanism that limits them. A major implication of this paradox is the difficulty of distinguishing genuine market inefficiencies from mere fluctuations. Investors often interpret price movements as signs of mispricing, but in many cases, these shifts simply reflect the market absorbing new information. As a result, many chase opportunities that either don't exist or disappear quickly after being noticed. The paradox also informs the debate between active and passive investing. Passive investors, who track market indices, operate on the assumption that markets are efficient and that attempting to beat them is unwise. This approach has gained traction in recent years, especially as evidence shows that actively managed funds often underperform passive ones over time. Still, it is the active investors, those seeking inefficiencies, who play a crucial role in maintaining the market's efficiency. Their analysis and actions help keep prices accurate, even if they don't consistently earn superior returns. Even sophisticated fund managers, armed with advanced tools and deep research, often struggle to outperform simple index funds once fees and costs are factored in. This highlights the challenge of consistent market outperformance. In effect, many investors are not beating the market. They're participating in a system that maintains its own efficiency through their collective efforts. Moreover, the paradox exposes the psychological dimension of financial markets. Investors are drawn to the idea of outperformance. It's an attractive narrative that suggests rewards for those clever or bold enough to outwit the market. But this belief can lead to overconfidence and underestimation of just how difficult it is to gain an edge in a highly efficient system. Many investors find themselves in a repetitive cycle of trying to outthink a market that already reflects collective wisdom and information. Ultimately, the market efficiency paradox illustrates the tension between the pursuit of superior returns and the reality of market dynamics. While inefficiencies may appear to exist, the efforts to exploit them typically eliminate them. Investors striving to outperform a market are often the very force that reinforces its efficiency. This paradox is a reminder that in the realm of finance, the relentless search for an edge often leads to outcomes that defy the initial intent, greater efficiency and fewer exploitable opportunities. The scarcity paradox. Human nature assigns value to scarcity. If only a few people can have something, it must be special. This instinct applies to art, luxury watches, real estate, and especially financial assets. In markets, scarcity can drive demand far beyond what fundamentals justify. Investors often chase what's limited, not what's rational. This is the scarcity paradox. The rarer something is, the more desirable it becomes, even if its underlying value doesn't support the price. This dynamic is clearest in collectibles. Take fine art. A painting by a dead artist is inherently scarce. There will be no more. The supply is fixed. When one comes to auction, collectors bid not just on its beauty or cultural significance, but on its rarity. The price isn't tied to earnings, cash flow, or productivity. It's tied to how few exist and how many want one. The same logic applies to vintage watches, first edition books, and baseball cards. Scarcity creates a perceived value that often exists outside traditional valuation models. In financial markets, scarcity often shows up with assets that have a fixed supply. Bitcoin is a prime example. There will only ever be 21 million Bitcoins, a limit coded into its protocol. As demand increases and supply remains fixed, the price rises. Many investors don't analyze it like a business. They don't request cash flow statements or income projections. They buy it because it's scarce, and they believe others will want it more in the future. That belief becomes self-reinforcing. Price climbs, not because of fundamentals, but because of faith in scarcity itself. During Bitcoin's early ascent, critics highlighted its lack of intrinsic value. It produced nothing, yielded nothing. It was just code. But those critiques only added to its allure. If something so intangible could attract so much attention, and price movement. It had to be special. Investors weren't just buying an asset. They were buying an idea powered by scarcity. The same psychology that drives collectors also fuels speculators. If everyone wants something and there's only a little of it, prices can keep climbing. This logic drove the NFT boom. NFTs, or non-fungible tokens, are digital certificates of ownership for unique digital items. Images, tweets, video clips. In theory, anyone can copy the content, but only one person owns the original token. The idea of digital scarcity, creating rarity where none naturally exists, allowed people to sell JPGs for hundreds of thousands of dollars. It wasn't about the content. It was about the uniqueness, however artificial. Markets didn't ask if NFTs had enduring value. They asked how rare they were and how many people might want them next. Scarcity also drives real estate prices, particularly in cities with limited land, Manhattan, London, Hong Kong. These markets are expensive not just because of economic activity, but because there's not much space left. People buy property not just to live in, but because they believe others will continue to want it. Even if the rental income doesn't justify the price, the expectation that demand will rise fuels buying. Scarcity turns into a pricing engine, but scarcity can cloud judgment. When assets are valued purely for being rare, fundamentals often fall away. Investors stop asking what something is worth. They only ask what someone else might pay later. Assets become speculative vehicles, driven by sentiment and fear of missing out. This disconnection between value and price can last longer than expected. Bubbles form, and when belief fades, they burst. Tulip mania in 17th century Holland is one of the earliest recorded examples. Certain tulip bulbs became wildly valuable because of rare viral mutations that created unique color patterns. At the height of the mania, a single bulb could sell for more than a house. The bulbs had no productive use. They generated no income. Their value came purely from their rarity and the hope someone else would pay more. When sentiment shifted, prices collapsed. The fundamentals hadn't changed. Belief in scarcity had. Scarcity doesn't automatically equal value. A rare item is only valuable if people want it. Plenty of things are scarce but worthless. A misprinted coin might be one of a kind, but if no one wants it, it has little market value. The same applies to obscure stocks with a low float. They might be hard to acquire, but that doesn't make them good investments. Rarity is a necessary condition for premium pricing, but it's not sufficient. Demand must accompany it. Sometimes scarcity is manufactured. Sellers create artificial limits to drive demand. Limited editions, exclusive drops, only 1,000 available campaigns. These tactics manipulate perception. When people believe something is scarce, they act fast and emotionally. This happens in markets too. A stock with a low float might be hyped as a scarcity play. Traders pile in, expecting a small supply to push the price higher. But this creates volatility and price distortion, especially if the underlying business is weak. Scarcity also distorts investor reasoning. When something is rare, people assume it must be valuable, even if they don't understand it. This illusion of value drives demand. Investors fear being left behind. They imagine what others might pay. That fear fuels buying, which raises prices, which validates the fear. The cycle continues. Scarcity becomes its own justification. This is how hype-driven markets behave. They rely on belief, not balance sheets. Traders chase momentum, not fundamentals. Scarcity gives them a reason to hold, or to jump in, but it also creates fragility. When prices are high and liquidity is low, even a slight change in sentiment can trigger a sharp drop. Suddenly, no one wants to buy. What was once prized for its rarity becomes illiquid and risky. The same scarcity that drove prices up now becomes a liability. The scarcity paradox reminds us, rarity alone is not enough. It can attract attention. It can spark temporary spikes, but it does not guarantee staying power. When people buy solely because there's not much of something, they're betting on belief, not value. That's fine if they understand the game, but many don't. They assume the price reflects substance. They believe scarcity equals safety. It doesn't. It only means fewer people can own it. It's the safe asset paradox. They anchor portfolios. They offer reliability in a world full of risk. Treasury bonds, high-grade government debt, and certain types of cash equivalents are considered nearly immune to default. In crisis, investors run to them. In uncertainty, they serve as a store value. They don't offer high returns. That's not their job. They offer safety. But when everyone runs to the same so-called safe asset, something happens. Prices rise. Yields fall. Liquidity dries up in the wrong places. Distortions build. A market designed to offer stability becomes the epicenter of crowding, fragility, and in extreme cases, failure. This is a safe asset paradox. The more people believe in the safety of an asset and crowd into it, the less safe that asset becomes. The paradox begins with demand. In uncertain environments, capital floods toward perceived safety. U.S. Treasuries are the prime example. During global stress, wars, recessions, pandemics, investors buy treasuries not for return, but for survival. That demand pushes prices up and yields down. In the short term, that's fine. But over time, when everyone does the same thing, the safety net gets stretched thin. At extremely low yields, treasuries stop acting like a source of income and start acting more like cash, with duration risk. Investors still hold them because they think they're safe, but they now face new dangers. Inflation eroding real returns, or interest rate shifts triggering price declines. The asset still seems safe, but its behavior has changed. Most investors don't adjust. They keep treating it like a no-risk option. The 2020 to 2021 bond rally is a good example. Central banks slashed interest rates to support the global economy. Investors rushed into government bonds. Yields on some 10-year sovereign debts dropped near, or even below zero. At those levels, the upside was gone. Bonds offered no cushion. Yet investors continued to pile in, not because the assets were attractive, but because they were safe. When inflation returned in 2022 and rates rose quickly, those same bonds lost value fast. The safety they promised vanished. People who thought they held low-risk investments watched their portfolios take unexpected hits. Liquidity is another issue. Safe assets are assumed to be easily tradable. They're the assets you can sell quickly when you need cash. But that assumption breaks down when everyone wants to sell at once. During the 2008 financial crisis, parts of the mortgage-backed securities market, previously rated as ultra-safe, froze. Investors realized too late that their safe assets were only safe when no one else needed to sell. The market couldn't absorb the volume. Buyers vanished. Prices fell off a cliff. The paradox isn't limited to bonds. Money market funds are also seen as safe. They aim to keep a stable value, typically $1 per share, and invest in short-term, high-quality debt. But even these instruments have broken under pressure. In 2008, the Reserve Primary Fund broke the buck after exposure to Lehman Brothers. That triggered a run. Investors panicked. Regulators stepped in. It was a rare event, but it exposed the fragility hidden in crowd behavior. When everyone believes they can exit safely, no one is prepared for the moment they can't. Even in equities, the same dynamic plays out. Certain large-cap stocks, mega-cap tech, consumer staples, or defensive sectors, are seen as safe havens. They have strong balance sheets, stable earnings, global reach. Investors buy them during uncertainty. As the crowd piles in, prices rise. The stocks become more expensive. The perceived safety gets priced in. At a certain point, valuation risk becomes a new danger. A safe stock trading at 40 times earnings isn't safe anymore. It's fragile. Any disappointment leads to a sharp drop. It's not the business that's risky. It's the expectation baked into the price. Gold offers another angle. It's considered a hedge against currency collapse, inflation, and political instability. In times of fear, investors turn to it. But gold doesn't generate income. It just sits. Its price is driven entirely by belief. Belief that others will also see it as a store value. When that belief becomes consensus, the trade gets crowded. And when something changes, interest rates rise, inflation cools, the dollar strengthens. Those who ran to gold often rush back out. The asset didn't become less stable. The crowd just changed direction. The safe asset paradox becomes more dangerous when institutions are involved. Banks, insurance companies, and pension funds all hold large amounts of safe assets. They use them to match liabilities, satisfy capital requirements, and manage liquidity. When these assets perform as expected, the system works. But when crowding leads to overexposure or when correlations shift, the safety can disappear. In early 2023, Silicon Valley Bank failed in part due to large holdings in long-dated treasuries and mortgage securities. These were seen as safe. But when rates rose, their value fell. SVB had to sell a loss. That loss triggered deposit outflows. The assets weren't bad. They were misaligned with the bank's liquidity needs. The assumption that safe assets could cover obligations failed under stress. Crowding also distorts policymaking. When everyone wants to hold the same safe asset, governments and central banks may feel pressured to meet that demand. They may expand issuance, adjust regulations, or intervene in markets. This creates moral hazard. It encourages a belief that safety will always be guaranteed. That belief reinforces crowd behavior. It builds systemic risk. The paradox deepens because investors rarely question the herd. Safety feels strongest when everyone agrees. When a consensus builds around an asset class being low risk, few look closer. If you ask, what happens if everyone tries to exit at once? What happens if yields rise? What happens if inflation returns? The very consensus that makes the asset feel secure becomes a fuel for its instability. This isn't just theory. Financial history is full of moments when the safest assets became the source of crisis, not because they were flawed, but because the crowd turned them into something they weren't. Stability depends not just on the asset itself, but on how it's used, how it's priced, and how quickly sentiment can change. The safe asset paradox reminds us that no asset is safe in isolation. Safety is contextual. It depends on liquidity, price, timing, and crowd behavior. An asset that's safe for one investor at one price can be dangerous for another when expectations shift. The more universally accepted something becomes as a safe place to park capital, the more vulnerable it is to the effects of overconfidence and crowding. Risk doesn't just come from volatility or default. It comes from assumptions. And the assumption that safety is permanent is one of the most dangerous in finance. The moment you stop questioning, the risk is already growing. Safe assets work until everyone believes they're guaranteed. That belief is what makes them the inflation hedge paradox. Inflation is a persistent force that erodes the purchasing power of money over time. As the cost of goods and services rises, each dollar you hold today buys less tomorrow. To counter this, many investors turn to assets like gold and real estate, which are widely considered to be inflation hedges. The logic is simple. When inflation rises, the value of these assets should increase, preserving the purchasing power of wealth. However, the relationship between inflation and the performance of these assets is not always straightforward. Sometimes these so-called inflation hedges fail to live up to their reputation, creating what could be called the inflation hedge paradox. Gold has long been viewed as a safe haven during times of inflation. As the price of goods and services rises, people often buy gold because it has traditionally maintained its value. This is especially true during periods of high inflation or economic uncertainty. The idea is that, unlike paper money which can be printed in unlimited quantities, gold is a finite resource, making it immune to the devaluation that affects currencies. In theory, when inflation rises, the value of gold should rise with it as more people seek to preserve their wealth. Yet there are times when gold fails to act as an effective hedge. During periods of deflation or low inflation, gold prices can stagnate or even decline. This is because gold's price is influenced not only by inflation but also by interest rates, currency strength, and global economic conditions. For instance, when interest rates are high, investors may shift their money into bonds or other fixed-income investments that provide better returns, reducing demand for gold and causing its price to drop, even if inflation is rising. Similarly, a strong U.S. dollar can offset inflationary pressures, making gold less attractive. The 1970s are often cited as a time when gold acted as a strong inflation hedge. During this period, inflation in the U.S. soared and gold prices skyrocketed, peaking at over $800 per ounce by the end of the decade. In this case, Gold performed as expected, rising in value alongside inflation. However, the 2000s tell a different story. Following the 2008 financial crisis, gold prices initially surged as investors sought a safe haven. But during the subsequent years of low inflation, gold's price leveled off or declined, failing to provide the same protection it had in the past. Real estate is another asset commonly seen as an inflation hedge. Like gold, real estate has a long history of maintaining its value during inflationary periods. The theory is that as the cost of living rises, so too does the cost of housing. Real estate can also provide rental income, which may increase with inflation. Its physical nature and potential for appreciation make it attractive for preserving wealth. However, real estate doesn't always respond to inflation as expected. Property values may rise with inflation, but are also affected by interest rates, supply and demand, and government policy. When interest rates rise, borrowing becomes more expensive, which can reduce housing demand and lead to falling property values. This was evident during the 2008 housing crisis, when real estate prices plummeted despite inflationary pressures elsewhere. The rapid rise in housing prices before the crisis was driven more by speculative behavior and easy credit than by inflation. When the market corrected, prices fell sharply, causing significant losses for many investors. Additionally, real estate is less liquid than assets like gold or stocks, making it harder to sell or convert to cash during economic uncertainty. For example, during the early stages of the COVID-19 pandemic, many real estate markets experienced a sharp slowdown as buyers and sellers exited. In some regions, property prices stagnated or fell, even as inflation rose in other parts of the economy. This showed that real estate could fail to function as an inflation hedge during times of market dislocation. The inflation hedge paradox also challenges the broader idea of what qualifies as an inflation hedge. Investors often seek assets that are positively correlated with inflation, assuming these will protect against its effects. But in some cases, inflation can harm these very assets. Rapid inflation can lead central banks to raise interest rates to cool the economy. These higher rates can hurt both gold and real estate by reducing demand. Gold may lose appeal compared to interest-bearing assets, while real estate becomes less affordable due to higher mortgage rates. Inflation can also lead to economic slowdowns. As rising prices erode consumer purchasing power, demand for goods and services may drop, slowing economic growth. This can, in turn, hurt the value of assets like real estate or stocks. In such scenarios, the very inflation that investors hope would increase asset values ends up triggering conditions that lead to declines instead. This leaves investors wondering how inflation, expected to protect their wealth, has instead diminished it. Moreover, inflation is often unpredictable. A sudden surge might briefly lift the value of gold or real estate, but if inflation expectations aren't sustained or the economy slips into recession, those gains may evaporate. The relationship between inflation and asset prices is not linear. There's no guarantee that an inflationary environment will lead to higher returns from traditional hedges. In fact, inflation can sometimes do more harm than good, distorting markets and increasing uncertainty about the future. The inflation hedge paradox challenges the assumption that assets like gold and real estate always perform well during inflationary times. While they have historically offered some protection, there are moments when they fail to deliver. Inflation doesn't operate in isolation. It interacts with interest rates, economic cycles, and investor psychology. When these factors align in unexpected ways, the protective value of gold, real estate, or other traditional hedges can be diminished or even reversed. For investors, it's important to recognize the limits of these hedges and consider alternative or complementary strategies. While gold and real estate may still hold a place in an inflation protection portfolio, relying solely on them can expose unforeseen risks. The inflation hedge paradox underscores the importance of diversification and a deeper understanding of how inflation interacts with different asset classes. The diversification paradox. The basic idea behind diversification as an investment strategy is simple. By spreading investments across different assets, industries, or geographic regions, you reduce overall risk. The logic is that if one asset or sector performs poorly, others in portfolio might perform better, thus balancing the impact. In theory, a diversified portfolio should protect an investor from the worst outcomes. Yet, there's a paradox at the heart of this strategy. Diversification reduces risk until everything crashes together. To understand this paradox, it's helpful to examine how diversification works under normal market conditions. Imagine a portfolio containing a mix of stocks, bonds, real estate, and perhaps some commodities like gold. If stocks take a hit due to a market correction, other sectors, such as bonds, might remain stable or even rise in value, softening the blow to the overall portfolio. Real estate and commodities often move according to their own economic cycles, further contributing to this protective effect. The more diverse the assets, the less likely that a downturn in one area will cripple the entire portfolio. This principle underpins modern portfolio theory, which advises investors not to put all their eggs in one basket. For example, investing only in the stock market exposes you to high volatility and sector-specific risks. Spreading investments across various asset classes reduces exposure to any single point of failure, offering a potentially smoother ride in the long run. However, this approach reveals its limitations when the market is hit by a systemic shock. In a typical economic downturn, different sectors may still behave independently. But in extreme events, such as financial crises or global pandemics, diversification can quickly lose its power. A vivid example of this paradox occurred during the 2008 global financial crisis. Many investors who believed they were well diversified, holding stocks, bonds, and real estate, saw nearly every asset class decline. Stock markets plunged, real estate collapsed, and even bonds and gold, usually safe havens, faltered. The crisis affected virtually every part of the global economy, revealing how interconnected financial systems had become. There was no safe refuge. Everything fell together. This pattern repeated during the early stages of the COVID-19 pandemic. As the virus spread and lockdowns were imposed, global markets tumbled. Stocks, bonds, oil, and other commodities were all impacted. Oil even traded at negative prices for the first time in history. Once again, the breadth of the crisis overwhelmed the protective benefits of diversification. The core of the diversification paradox is this. The strategy works well in normal times but falters under systemic stress. This is troubling for investors who rely heavily on diversification to manage risk. While it can reduce the chance of severe losses during typical market cycles, it cannot guarantee protection during extraordinary events. Today's global markets are deeply interconnected. A financial shock in one region can ripple quickly through the rest of the world. The collapse of a major bank or a disruption in a key supply chain can impact everything from equities to commodities. Because of this interdependence, diversification no longer offers the same degree of protection during large-scale crises. Additionally, diversification is based on historical correlations, like the idea that bonds and stocks move in opposite directions. This assumption often holds true in mild disruptions, but can fail in extreme situations. During crises, investors tend to sell everything indiscriminately to raise cash, leading to broad market declines and causing correlations to spike. The very relationships that diversification depends on begin to break down. So while diversification can protect against specific risks, such as a failure of a company or a sector, it cannot eliminate systemic risk, which is a risk that the entire financial system or global economy may collapse under pressure. In short, diversification is a useful but imperfect tool. It works under most circumstances, but may offer little defense when it's needed most. Understanding this limitation is crucial for investors aiming to manage risk wisely. No strategy is foolproof, and diversification, while valuable, should not be viewed as an all-encompassing safety net. Being aware of the diversification paradox is a key step in preparing for the realities of investing in an unpredictable world. The bubble paradox. Signs are there. Rising prices divorced from fundamentals, speculative buying, the fear of missing out driving irrational behavior. History gives you plenty of examples. You recognize the pattern. But even when the bubble is obvious, you can't say when it will end. You know it will pop. You just don't know when. That's the bubble paradox. The clearer a bubble becomes, the harder it is to predict its collapse. You can spot a bubble by how people talk. Everything becomes about price. Not value, not income, just price. In a housing bubble, Everyone talks about how much their home has appreciated. In a stock bubble, people stop asking about profits and start asking how quickly a stock can double. During the dot-com boom, the phrase new economy became a justification for abandoning earnings altogether. It didn't matter if the company had revenue. What mattered was clicks, users, growth, anything that could suggest a big future. When prices rise fast enough, the story justifies itself. People stop asking why and focus only on how high. But even as things look irrational, prices keep going up. That's what makes bubbles so hard to resist. Being early is the same as being wrong. You might identify the bubble correctly, but if you act on it too soon, you miss out. Or worse, you lose money while others get rich. Imagine you spot a tech stock that's overvalued. You short it at $80. Then it goes to $150. Then $300. You were right, eventually, but if you had limited capital or a stop-loss order, you got crushed long before the bubble popped. Markets don't move on logic alone. They move on behavior. And during bubbles, behavior breaks from reality. Investors buy because others are buying. They believe in momentum. They believe that someone else will pay more tomorrow. That's the greater fool theory in action. As long as you're not the last one holding the asset, you win. And for a while, that works. The Bitcoin rallies offer a modern case study. In 2017, the price soared to nearly $20,000. Commentators called it a bubble. Then it crashed below $4,000. They said the bubble had burst. Then it rallied to over $60,000 in 2021. Was the bubble back? Or was it the same one expanding further? It dropped again, then recovered. At every stage, people called it a bubble, and at many stages, they were right. But timing the collapse proved nearly impossible. Even now, debates continue. Is it overvalued? Is it underappreciated? Bubbles don't end with clarity. They end with a break in belief. Housing markets show the same pattern. Before the 2008 crisis, home prices rose for years. People warned of a bubble as early as 2003, but prices kept rising. Lenders kept lending. Buyers kept buying. Fundamentals were stretched, but momentum carried the market forward. It wasn't until mortgage defaults surged, credit froze, and trust broke that the market collapsed. The warnings were early and accurate, but most who acted on them before the break missed years of upside or were dismissed as alarmists. That's the core problem with bubbles. Recognition doesn't equal timing. Markets can stay irrational longer than you can stay solvent. And in the meantime, you're under pressure. Everyone else is making money. You look cautious or even foolish. You get asked why you're sitting on cash. You watch gains go by. You doubt yourself. And when the bubble does pop, it's not clean. Prices don't fall all at once. They grind down. They bounce. They trap short sellers and lure back buyers. Popping isn't instant. It's a process. There's also the problem of incentives. In a bubble, people benefit from it continuing. Investors, fund managers, banks, media, everyone profits as long as the market keeps climbing. So there's little reason to call a top. Anyone who does risks ridicule. And even if you're right, you're fighting the tide. The dot-com boom made stars out of analysts who pitched speculative IPOs. The ones who warned of froth were ignored until it was too late. The bubble paradox doesn't just trap individuals. It traps institutions. Central banks see the warning signs but hesitate to act. Regulators know leverage is building but don't want to spook the market. Politicians enjoy the illusion of prosperity. Everyone has a reason to let it go a bit further, and each delay makes the burst worse. But the burst does come. It always comes. Bubbles don't end with moderation. They end with a break, something that causes belief to collapse. It might be a rate hike. It might be a scandal. It might just be fatigue. But when it happens, buyers vanish. Liquidity dries up. Sellers outnumber takers. Prices fall fast and then faster. What took years to build can unwind in weeks. This collapse often feels sudden, but it's not. It was building all along. You just couldn't say when the last bid would disappear. And even after a collapse, people rewrite the story. They say it was obvious. They pretend they knew all along. But most were either swept up in it or stayed out entirely. Few timed both the entry and exit right. That's the cruel joke of bubbles. Being right about them often brings no reward. You're either early and ignored or late and hurt. Timing is everything, and almost nobody gets it perfect. So, what do you do if you see a bubble forming? That's the hard question. Avoiding it entirely may mean sitting out for years. Shorting it means risking ruin. Participating in it means dancing close to the edge. Some try to ride the wave with stop losses or trailing exits. Others set strict valuation rules and exit when those are breached. But even then, you're exposed to being wrong for long periods. You look out of touch while others are making money. The paradox doesn't end when the bubble bursts. Afterward, disillusionment sets in. People swear off the asset class. They become hyper-cautious. They say they'll never fall for it again. But memory fades. A new story appears. A new generation enters. And the cycle begins again. Because bubbles aren't just financial phenomena. They're psychological. They are driven by belief, momentum, greed, and fear, and those don't change. You can study the history. You can recognize the pattern. You can stay grounded in fundamentals. But the moment of the pop, the moment, remains out of reach. It doesn't flash a warning. It doesn't give you time to prepare. It just happens. And when it does, all the clarity of hindsight kicks in. That's the bubble paradox. You can know you're in one. You can be certain it will end, but you still won't know when. The insider paradox. Insiders at a company know more than any outsider could. They see the operations, the real numbers, the internal discussions. They don't rely on quarterly filings or earnings calls. They live the business day to day. So when they buy or sell stock, investors pay attention. The logic is simple. If a CEO or CFO is buying shares with their own money, it must be a good sign. If they're selling, maybe trouble is coming. But the relationship isn't that straightforward. Insider trades can be noisy, inconsistent, and hard to interpret. That's the insider paradox. Insiders know the most, yet their trades don't consistently predict where the stock is going. In theory, insider buying should signal confidence. These are people who know the product pipeline, the contracts in negotiation, the hiring trends, the customer feedback. They should have the best information, and sometimes they do. If several senior executives buy heavily right before strong earnings, the stock might surge. But these cases are rare. Most insider activity is more routine. A director buys a modest amount. A VP sells shares from a compensation package. A co-founder sells for estate planning. Each of these actions is legal, and each muddies the waters. Insider selling, in particular, is difficult to read. People sell for many reasons: diversification, buying a home, paying taxes, reducing concentration. Selling doesn't always mean bad news is coming. Sometimes it means nothing at all. A founder with 80% of their net worth in company stock will eventually need to sell, even if they still believe in the company. If you read too much into it, you may misjudge the situation. Buying can be just as ambiguous. Insiders may purchase shares to send a message, to show confidence, to calm the market after a sell-off. But that doesn't necessarily mean fundamentals are improving. They may believe in the long-term story, while knowing short-term problems remain. Their buy might reflect hope, not certainty. It can be symbolic rather than predictive. Timing adds another layer. Even when insiders are right about the direction of the business, the stock price might not follow in the same time frame. A CFO might buy stock believing a product line will boost revenue in 2 years, but if the market is focused on current earnings, the price could drop. The insider was right in substance, but wrong in timing. For investors looking to profit from insider moves, that's a problem. The trade didn't work, even though the logic was sound. Regulations complicate things further. Insiders can't buy or sell whenever they want. They're restricted by blackout periods and disclosure rules. Trades must be reported via Form 4 and become public within days. By the time investors see the trade, it's already done, and the price may have moved. The edge is gone. Because of these restrictions, insiders often act cautiously. They may spread purchases over time or make small trades to avoid drawing attention or triggering compliance issues. Academic research reflects the paradox. Studies show insider buying has some predictive value, but it's modest. It's more meaningful when multiple insiders buy after a price drop. Cluster buying can be a stronger signal, but even then, it's not a guarantee. Insider trades improve odds. They don't offer certainty. They're one signal among many, alongside valuation, momentum, macro conditions, and sentiment. Some investors build strategies around insider activity. They watch the filings, look for patterns. But results are mixed. A strategy that buys after every insider purchase underperforms one that filters for trade size, frequency, and context. $$5,000 buy isn't the same as a $$500,000,001. A CEO doubling their stake carries more weight than a director making a symbolic gesture. But it takes work to separate signal from noise, and even then, the future remains uncertain. There's also a psychological element. Investors love stories. Insider buying fits a compelling narrative. They know more than me, and they're buying. I should follow. It feels like a glimpse behind the curtain, but that simplicity can mislead. Insiders may be wrong, overconfident, or misjudging how the market will respond. Knowing the business doesn't mean knowing the stock. The price reflects not just operations, but expectations, perception, and positioning. During crises, insider behavior becomes even harder to interpret. In downturns, insiders may buy to show faith or stabilize a stock. Motives blur. Investors want confidence, but they also want honesty. A CEO buying shares while cutting staff may appear either strong or tone-deaf. Context matters. Insiders aren't immune to bias. They believe in their company, and that belief can cloud their judgment. They might underestimate risks or overrate prospects. Their trades reflect those biases. Like any investor, they bring emotion to the table. They may feel pressure to support the stock or to prove something to the market. These motives aren't always rational. They're human. In some cases, insider trades are automated. Executives set up 10b5-1 plans, prearranged selling programs that execute regardless of news. These reduce the appearance of trading on non-public information, but to outsiders, it can be hard to distinguish. A stream of steady sales might look like a warning, even if it's just a preset plan. Ultimately, insider trades offer a sliver of insight, not a roadmap. They can confirm a thesis or add context to a decision, but they shouldn't be used in isolation. The paradox remains. Those with the most knowledge often trade for reasons unrelated to that knowledge. They act with constraints, emotions, and blind spots. Their actions are worth noting. The efficiency versus stability paradox. Modern systems, across industries from manufacturing to finance, are increasingly designed for leaner operations and tighter margins. Every process, resource, and delay is optimized to eliminate waste. This results in faster delivery, lower costs, and higher profits. But there's a catch. The more efficient a system becomes, the less room it has for error. Buffers disappear. Slack is removed. There's no cushion. This is the efficiency versus stability paradox. By chasing peak performance, we often eliminate the very elements that help us survive disruptions. Nowhere is this trade-off more visible than in supply chains. For decades, manufacturers adopted just-in-time JIT inventory systems. Instead of stockpiling parts, they relied on precise delivery schedules. Inventory costs dropped, cash flow improved. It was a model of efficiency, but it also made the system fragile. Any disruption, a strike, a shipping delay, could halt production. During the COVID-19 pandemic, this vulnerability became clear. A single missing part stranded at a port could shut down entire factories. Supermarkets ran out of essentials. Car production stopped due to chip shortages. These systems were optimized for speed, not for shocks. Finance reveals a similar pattern. In the race for faster execution and lower transaction costs, markets embrace high-frequency trading and algorithmic strategies. Under normal conditions, these systems work well, offering liquidity and efficiency. But during stress, they can amplify volatility. Algorithms pull liquidity, chase price momentum, or trigger feedback loops. The 2010 flash crash revealed this fragility. Markets plunged and rebounded in minutes, without a clear cause. The system functioned flawlessly until it didn't. Banks followed the same trajectory before the 2008 financial crisis. Institutions streamlined operations, increased leverage, and expanded credit. Risk was repackaged and sold as mortgage-backed securities that promised safety and returns. Capital requirements were finely tuned. But the system was brittle, relying on ever-rising home prices and never missing payments. When reality shifted, the structure collapsed. Banks had been efficient but not resilient. Energy grids faced the same paradox. To cut costs, power systems operate close to capacity. Every generator, transmission line, and control center is maximally utilized. That's efficient, but it leaves no margin for error. A heat wave, cyber attack, or equipment failure can cascade into widespread outages. The 2021 Texas power crisis showed the danger. Blackouts spread, water systems failed, and millions were left in the cold. Backups were scarce, because backups are inefficient by design. Lean business structures also embody this risk. Companies reduce headcount, cut layers, and minimize spending. They're agile and profitable. But when someone quits or gets sick, there's no redundancy. Projects stall. Institutional knowledge vanishes. A hyper-efficient team can't absorb unexpected change. In contrast, firms with overlapping roles, cross-training, and slack time might seem bloated in normal times, but they're more stable when surprises hit. Airlines are a vivid example. Schedules, crews, and aircraft are tightly optimized to minimize costs. Planes run full. Staff are fully booked. But one snowstorm or tech failure can throw the entire network into chaos. Delays ripple, connections are missed, cancellations multiply. Passengers experience the cost of hyperefficiency firsthand. Even agriculture shows the same pattern. Monoculture, planting a single crop across vast areas, is efficient. It simplifies everything, but it increases risk. A single pest, drought, or supply shock can wipe out the harvest. Biodiversity may be less efficient, but it builds resilience by spreading risk. Software development mirrors this as well. Engineers optimize code, reduce redundancies, and centralize services. Hosting is cheaper, performance improves. But this creates single points of failure. If a cloud provider fails or a dependency is compromised, thousands of services can go down. Efficient systems often lack the independence to isolate problems when things go wrong. Part of the issue is that fragility hides in success. When systems perform well, they look invincible. They do more with less, cut costs, and outperform. And because they work so well during normal times, it's tempting to believe they'll survive stress. But stress doesn't appear in spreadsheets. It arrives through rare but high-impact events, the kind we tend to ignore until it's too late. Nature offers a different model. Trees drop thousands of seeds, knowing most will fail. Bodies store fat, not for efficiency, but for survival. Ecosystems maintain diversity, not to maximize output, but to adapt. These systems embrace what looks like waste in the short term to ensure longevity. They prioritize resilience over optimization. That's the lesson modern systems often forget. In stripping out slack, we remove the shock absorbers. We edge closer to collapse. What used to be minor fluctuations become crises. What once bent now breaks. This doesn't mean efficiency is bad. It's delivered enormous gains. Lower prices, faster access, better output. But efficiency comes with trade-offs. And those trade-offs turn dangerous when we forget they exist. Building stability means accepting some inefficiency. It means paying for redundancy, holding inventory, cross-training teams, tolerating downtime. These things seem wasteful until they're suddenly essential. The paradox lies in the gap between what works today and what survives tomorrow. Efficient systems win when things go right. Stable systems endure when things go wrong. Most aim to be both. But as they optimize for one, they often weaken the other. The more perfect we try to make a system, the more brittle it can become. And when stress hits, the safeguards we remove, the cheap stock paradox. The cheap stock paradox often catches the eye of investors looking for a bargain. A stock trades at a low price-to-earnings ratio or well below its historical average. Maybe it's trading under book value. Maybe the price has dropped 60% over the past year. On paper, it looks like an opportunity. Buy low, wait for the market to recognize its mistake, then sell high. That's the thinking. But here's the problem. Cheap can always get cheaper. Just because a stock is down doesn't mean it's done falling. The cheap stock paradox reminds investors that low valuation is not the same as good value. A stock trades at a low price for a reason. Sometimes that reason is overreaction. The market panics after a bad quarter, news hits hard, and sentiment drops faster than the numbers justify. If the business remains sound, a temporary decline can be a buying opportunity. But often, a falling stock signals real, lasting problems. The business model may be breaking down. Revenue could be shrinking, costs rising, management losing credibility, or the company may be operating in a dying industry. A cheap stock may reflect risk more than reward. Take a company trading at 5 times earnings. That sounds like a deal, especially when the market average is closer to 20. But if those earnings are falling each quarter, the multiple is misleading. If the company earned $2 per share last year and is expected to earn only $1 this year, the true multiple has doubled. And if earnings go to zero, there is no multiple. The company is now just a name with a stock price. That price may be low, but it's not cheap in a meaningful way. It's cheap because nobody wants it, and they may be right. Investors often confuse low price with undervaluation. They see a stock trading at $3 and assume it must be a better buy than one at $300. But price alone means nothing. A $3 stock with no earnings, no growth, and mounting losses could be headed to $0. Meanwhile, the $300 stock might be growing profits at 20% annually with strong margins and a solid balance sheet. Cheapness is not defined by absolute price, but by value relative to quality. A stock is only undervalued if it's trading below what it can reasonably be expected to produce in the future, and that's harder to measure than it looks. The cheap stock paradox becomes dangerous when investors fall into the trap of mean reversion. They assume that a stock that once traded at $50, now trading at $10, must eventually bounce back. They believe the market will realize its mistake and correct it. But there's no rule that says a stock must return to its past highs. Companies change. Markets evolve. A business that earned money 5 years ago may never recover. Retailers go bankrupt. Tech companies get outpaced. Industries get disrupted. A cheap stock may simply be a fading company with no real path back to relevance. One example is BlackBerry, once a leader in mobile phones. It began to decline when Apple and Android took over. For years, investors pointed to its cheap valuation as a reason to buy, but the fundamentals kept deteriorating. The company lost market share. Revenue dropped. Even though it tried to reinvent itself as a software company, the transition took too long. The stock kept falling. It looked cheap the whole way down. The same happened with Sears, Kodak, and others. They looked cheap for years, but their business models were broken. The market was not wrong. It was pricing in decline. Another layer to this paradox is liquidity. A cheap stock may trade at low volume, making it harder to enter or exit positions without moving the price. Investors may find themselves stuck, unable to sell without taking a loss. This risk doesn't show up in valuation metrics, but it's real. Low-priced, low-volume stocks can be liquid traps. The bid-ask spread widens. Volatility increases. Small trades can cause large price swings. The risk isn't just that the stock gets cheaper. It's that you can't get out when you need to. There's also the psychological aspect. Investors tend to anchor expectations to previous highs. If a stock once traded at $100 and now sits at $15, they imagine a return to $100 as realistic. But that's not investing, that's hoping. And hope is not a strategy. Anchoring to old prices ignores the reasons a stock fell in the first place. It assumes the past is a guide to the future, when in many cases, it's a warning. The cheap stock paradox teaches that due diligence is critical before buying a low-price stock. Investors must ask hard questions. Why is it cheap? What does the market see that I might be missing? Are the earnings sustainable? Is the debt manageable? Is the business model still relevant? Does management have a plan, and can they execute it? A stock may be cheap for good reason. In many cases, the price is telling the truth. Even when a cheap stock is truly undervalued, timing is a challenge. It may stay cheap for a long time. The market doesn't always recognize value immediately. A turnaround could take years. During that time, the stock might drift sideways or continue to fall. This dead money risk ties up capital that could be earning returns elsewhere. A stock that looks cheap but moves nowhere for 5 years is not a good investment. Patience is important, but so is opportunity cost. There's also survivorship bias. When a cheap stock rebounds, it becomes a legend. People talk about how they bought it at $2 and sold at $20, but they don't talk about the 10 others they bought at $2 that went to zero. The market rewards those who get it right, but the odds in turnaround situations are low. For every winner, there are many that never come back. Chasing cheap stocks without a margin of safety is more like gambling than investing. A better approach is to focus not on how cheap a stock is, but why it's cheap and whether that reason is likely to change. Sometimes cheapness signals opportunity. More often, it signals trouble. Stocks with strong balance sheets, growing revenue, and competent leadership may be overlooked temporarily. That can create value. But stocks with deteriorating fundamentals and shrinking relevance are cheap for a reason. They don't deserve a higher price. The paradox reminds investors to be careful with the idea of bargains. Not everything on sale is worth buying. In investing, a low price tag often hides high risk. A stock at $2 can lose 100% just as fast as one at $200. And the cheaper it gets, the more tempting it looks until it disappears. The safe asset paradox. They anchor portfolios. They offer reliability in a world full of risk. Treasury bonds, high-grade government debt, and certain types of cash equivalents are considered nearly immune to default. In crisis, investors run to them. In uncertainty, they serve as a store of value. They don't offer high returns. That's not their job. They offer safety. But when everyone runs to the same so-called safe asset, something happens. Prices rise. Yields fall. Liquidity dries up in the wrong places. Distortions build. A market designed to offer stability becomes the epicenter of crowding, fragility, and, in extreme cases, failure. This is a safe asset paradox. The more people believe in the safety of an asset and crowd into it, the less safe that asset becomes. The paradox begins with demand. In uncertain environments, capital floods toward perceived safety. U.S. Treasuries are the prime example. During global stress, wars, recessions, pandemics, investors buy treasuries not for return, but for survival. That demand pushes prices up and yields down. In the short term, that's fine. But over time, when everyone does the same thing, the safety net gets stretched thin. At extremely low yields, treasuries stop acting like a source of income and start acting more like cash with duration risk. Investors still hold them because they think they're safe. But they now face new dangers, like inflation eroding real returns or interest rate shifts triggering price declines. The asset still seems safe, but its behavior has changed. Most investors don't adjust. They keep treating it like a no-risk option. The 2020 to 2021 bond rally is a good example. Central banks slashed interest rates to support the global economy. Investors rushed into government bonds. Yields on some 10-year sovereign debts dropped near or even below zero. At those levels, the upside was gone. Bonds offered no cushion. Yet investors continued to pile in, not because the assets were attractive, but because they were safe. When inflation returned in 2022 and rates rose quickly, those same bonds lost value fast. The safety they promised vanished. People who thought they held low-risk investments watched their portfolios take unexpected hits. Liquidity is another issue. Safe assets are assumed to be easily tradable. They're the assets you can sell quickly when you need cash. But that assumption breaks down when everyone wants to sell at once. During the 2008 financial crisis, parts of the mortgage-backed securities market, previously rated as ultra-safe, froze. Investors realized too late that their safe assets were only safe when no one else needed to sell. The market couldn't absorb the volume. Buyers vanished. Prices fell off a cliff. The paradox isn't limited to bonds. Money market funds are also seen as safe. They aim to keep a stable value, typically $1 per share, and invest in short-term, high-quality debt. But even these instruments have broken under pressure. In 2008, the Reserve Primary Fund broke the buck after exposure to Lehman Brothers. That triggered a run. Investors panicked. Regulators stepped in. It was a rare event, but it exposed the fragility hidden in crowd behavior. When everyone believes they can exit safely, no one is prepared for the moment they can't. Even in equities, the same dynamic plays out. Certain large-cap stocks, mega-cap tech, consumer staples, or defensive sectors are seen as safe havens. They have strong balance sheets, stable earnings, global reach. Investors buy them during uncertainty. As the crowd piles in, prices rise. The stocks become more expensive. The perceived safety gets priced in. At a certain point, valuation risk becomes the new danger. A safe stock trading at 40 times earnings isn't safe anymore. It's fragile. Not because the business is risky, but because the expectation baked into the price is. Gold offers another angle. It's considered a hedge against currency collapse, inflation, and political instability. In times of fear, investors turn to it. But gold doesn't generate income. It just sits. Its price is driven entirely by belief. Belief that others will also see it as a store value. When that belief becomes consensus, the trade gets crowded. And when something changes, interest rates rise, inflation cools, or the dollar strengthens, those who ran to gold often rush back out. The asset didn't become less stable. The crowd just changed direction. The safe asset paradox becomes more dangerous when institutions are involved. Banks, insurance companies, and pension funds all hold large amounts of safe assets. They use them to match liabilities, satisfy capital requirements, and manage liquidity. When these assets perform as expected, the system works. But when crowding leads to overexposure, or when correlations shift, the safety can disappear. In early 2023, Silicon Valley Bank failed in part due to large holdings in long-dated treasuries and mortgage securities. These were seen as safe. But when rates rose, their value fell. SVB had to sell at a loss. That loss triggered deposit outflows. The assets weren't bad. They were misaligned with the bank's liquidity needs. The assumption that safe assets could cover obligations failed under stress. Crowding also distorts policymaking. When everyone wants to hold the same safe asset, governments and central banks may feel pressured to meet that demand. They may expand issuance, adjust regulations, or intervene in markets. This creates moral hazard. It encourages a belief that safety will always be guaranteed. That belief reinforces crowd behavior. It builds systemic risk. The paradox deepens because investors rarely question the herd. Safety feels strongest when everyone agrees. When a consensus builds around an asset class being low risk, few look closer. But ask, what happens if everyone tries to exit at once? What happens if yields rise? What happens if inflation returns? The very consensus that makes the asset feel secure becomes a fuel for its instability. This isn't just theory. Financial history is full of moments when the safest assets became the source of crisis. Not because they were flawed, but because the crowd turned them into something they weren't. Stability depends not just on the asset itself, but on how it's used, how it's priced, and how quickly sentiment can change. The safe asset paradox reminds us that no asset is safe in isolation. Safety is contextual. It depends on liquidity, price, timing, and crowd behavior. An asset that's safe for one investor at one price can be dangerous for another when expectations shift. The more universally accepted something becomes as a safe place to park capital, the more vulnerable it is to the effects of overconfidence and crowding. Risk doesn't just come from volatility or default. It comes from assumptions. And the assumption that safety is permanent is one of the most dangerous in finance. The moment you stop questioning, the risk is already growing. Safe assets work until everyone believes they're guaranteed. That belief is what makes them unsafe. The high-yield paradox. You open a chart and see one bond paying 3%, another paying 9%. One stock yields 2%, another boasts 11%. If you're building an income portfolio, the math seems easy. Why settle for less when you can earn more? That's how it starts. Investors see high yield and assume it means better cash flow, more passive income, and faster compounding. But high yield is rarely free. It often comes with hidden risks. Credit deterioration, falling asset prices, dividend cuts, or poor fundamentals. Over time, these risks tend to show up not as smaller gains, but as outright capital losses. That's the high-yield paradox. The very assets promising high income often destroy the value needed to make that income matter. Start with high-yield bonds, also known as junk bonds. These are corporate bonds rated below investment grade. Companies that issue them tend to have higher debt loads, weaker cash flow, or more unstable business models. The bonds pay more because investors demand compensation for taking that credit risk. If the company stays afloat and makes all its payments, the investor gets a high yield. But that is where the trouble starts. When economic conditions shift, growth slows, interest rates rise, or earnings disappoint, default risk increases. Bond prices fall. The income may still be coming in for now, but the bond's market value drops. If the company misses a payment or restructures its debt, the bondholder could lose a big chunk of principal. Imagine buying a bond yielding 10%, more than triple what a treasury bond pays. But a year later, the bond's price drops 20% because the market fears the issuer won't survive the next downturn. That 10% income gets wiped out by a larger capital loss. If the company defaults, you could lose most of your investment. The yield never compensated for the real risk. This dynamic plays out in equities, too. A company offering a double-digit dividend yield should immediately raise questions. Why is the yield so high? In most cases, it's because the stock price has fallen. Dividends are calculated as a percentage of share price. If a stock trades at $100 and pays a $5 dividend, the yield is 5%. If the stock drops to $50 and keeps paying $5, the yield jumps to 10%. That doesn't mean the company became more generous. It often means investors are expecting trouble. Chasing high dividend yields without understanding the business behind them is a common mistake. Consider a struggling telecom company that pays a 12% dividend. On paper, it's appealing. But if revenue is declining, debt is rising, and capital expenditures are eating into free cash flow, that dividend may not last. Eventually, the company may cut the payout. When it does, the stock drops again. You didn't just lose income, you lost capital. You'd been better off with a 3% yield from a company with stable cash flow and a strong balance sheet. This isn't theory. It happens often. With energy companies during oil downturns, REITs in periods of falling occupancy, and financial firms with excessive leverage. What these have in common is high yields that attract attention, while the risks behind those yields get ignored until it's too late. In many cases, the dividends were unsustainable from the start. They were paid to signal strength or maintain appearances. When business conditions worsened, the illusion cracked. Investors learned that income isn't income if it comes at the cost of capital erosion. Closed-end funds and structured income products also fall into this trap. These vehicles often promise yields of 8%, 10%, or more. They use leverage, derivatives, or aggressive payout policies to hit those numbers. But they don't always generate enough income to support those payouts. Instead, they return capital to investors while labeling it distribution. Your account may show a steady stream of cash, but your investment is shrinking. You're just getting your own money back, minus fees, under the label of high yield. This paradox becomes more dangerous in low-rate environments. When interest rates are low, investors stretch for yield. They buy lower-quality bonds. They load up on dividend stocks without examining fundamentals. They invest in exotic credit instruments they don't fully understand. The demand for yield pushes prices up and yields down until a shock exposes the risks. Then capital flees. Prices collapse. Yields spike, but only because no one wants to buy. The assets become toxic, not rewarding. Preferred stocks and MLPs, master limited partnerships, also illustrate this paradox. Both can offer attractive yields, but both carry risks traditional investors often overlook. Preferred stocks may have fixed dividends, but they behave more like bonds and common equity. When rates rise, their prices fall. MLPs are sensitive to energy markets and regulation. When oil prices collapse or tax rules change, these income vehicles suffer large drawdowns. The yield looks stable until the environment shifted. One of the biggest traps in the high-yield space is the illusion of control. Investors tell themselves they'll sell before things get bad. They'll monitor the company. They'll watch for signs. But deterioration happens gradually, then suddenly. A bond trading at 98 today might fall to 90 next week and 75 the week after. A dividend stock might cut its payout overnight. By the time the red flags are obvious, the market has already priced in the damage. Getting out without loss is harder than it seems. This doesn't mean all high-yield investments are bad. Some companies can sustain high payouts. Some bonds offer good risk-adjusted returns. But the burden is on the investor to understand what's behind the yield. Why is it so high? What risks are being priced in? Is the income supported by actual earnings and cash flow, or is it based on hope and leverage? These are questions that must be answered before chasing the number. There's also the issue of reinvestment. Even if a high-yield asset holds its value for a while, the income it produces must be reinvested. If future opportunities carry the same risks or lower quality, the overall portfolio may become more fragile. What looks like a strong income stream becomes a compounding of risk. The smarter approach is to balance yield with quality. Focus on companies with strong fundamentals, consistent cash flows, and reasonable payout ratios. Accept a lower yield if it means better capital preservation. Use high-yield assets sparingly, not as a core of your portfolio. Look beyond the surface. High yield is never free. It's payment for risk, real risk, not just volatility. The high-yield paradox teaches us that income and total return aren't separate. You can't enjoy high income if capital losses erode your principal. A 10% yield means little if you lose 20% of your investment. The goal isn't to maximize yield. It's to build sustainable income that doesn't come at the cost of capital. Sometimes that means choosing the lower-yielding option, the one that keeps its value and lets you sleep at night. The moral hazard paradox. In a financial crisis, someone must act. Central banks and governments often step in as backstops. They inject liquidity, guarantee deposits, and bail out institutions. The aim is to prevent panic, maintain confidence, and avoid systemic collapse. Without such intervention, fear spreads, markets seize up, and a bad situation deteriorates further. Bailouts stabilize the system. They protect jobs, savings, and entire economies. But they also send a dangerous message. If you're big, important, or connected enough, you won't be allowed to fail. That's the moral hazard paradox. The very measures designed to prevent disaster can unintentionally encourage reckless behavior. Moral hazard arises when people or institutions take risks knowing they won't bear the full consequences of failure. If someone else absorbs a loss, the motivation to act responsibly weakens. In finance, this is particularly problematic. Banks, insurers, and investors operate in environments rife with uncertainty. If they believe losses will be socialized while profits remain theirs, they are more likely to take excessive risks, issuing risky loans, investing in complex high-yield products, or stretching leverage. The system becomes more fragile, ironically because its safety nets are so dependable. The 2008 financial crisis made this paradox painfully visible. Major banks bundled risky mortgages into securities rated as safe and earned billions. When the housing market collapsed, those assets became toxic, triggering a global financial meltdown. Panic set in. Credit markets froze. The U.S. government responded with massive bailouts, capital injections, guarantees from money market funds, and a $700 billion rescue package known as TARP. These steps stopped the bleeding, but they also reinforced the idea that failure at scale would be met with state support. Some banks failed, others took losses, but many executives remained in place. Some firms even paid bonuses using public funds. To ordinary citizens, the message was harsh. The same institutions that helped cause the crisis were rescued with taxpayer money, while homeowners lost homes, jobs vanished, and retirement accounts dwindled. This deepened public distrust and confirmed the suspicion that the powerful play by different rules. Since then, regulators have tried to reduce systemic risk. Capital requirements were raised, stress tests became routine, and resolution regimes were created to allow large institutions to fail in an orderly fashion. Still, market expectations haven't fully changed. When big banks falter, investors often assume they'll be bailed out. That assumption shapes behavior. Risk models get skewed, lending standards loosen, and safety nets breed overconfidence. The cycle repeats. Central banks face their own version of this paradox. Especially since 2008, they've gone beyond being lenders of last resort and become buyers of last resort. They purchase government bonds, mortgage-backed securities, and even corporate debt. This stabilizes markets but distorts incentives. Investors come to expect intervention, and asset prices reflect that expectation. Financial markets start to rely not just on fundamentals, but on policy support. This pattern emerged again during the COVID-19 crisis. In March 2020, markets collapsed and liquidity dried up. The Federal Reserve intervened swiftly, slashing interest rates, launching unlimited quantitative easing, and backing credit markets. These moves were essential to avoid economic collapse. But they also reinforce a pattern. When markets fall hard enough, help will arrive. That knowledge shapes behavior. Volatility becomes a buying opportunity. Traders position for intervention. Insurance systems reflect a similar dynamic. If a company knows it's insured, it may be less careful about avoiding loss. In banking, deposit insurance prevents runs, but it can also encourage aggressive risk-taking. Customers know their deposits are protected, so they don't scrutinize a bank's risk profile. That's why regulators impose strict rules on insured institutions. Without limits, insurance can trigger the very failures it was meant to prevent. Corporate bailouts bring another kind of moral hazard. When governments rescue large employers, airlines, automakers, or utility providers, they often cite job preservation, infrastructure, or national security. These are valid concerns. But each rescue teaches executives that failure might not be final. They can ignore problems, prioritize shareholders, and still expect support in a downturn. This erodes discipline, misallocates capital, and keeps weak firms afloat, not because they're efficient, but because they're protected. Public policy suffers too. Politicians want to ease pain, especially in crises. But short-term relief can postpone necessary reforms. If failing systems are continuously propped up, they don't evolve. They become dependent. Over time, that fragility is more dangerous than collapse. Markets function best when prudence is rewarded and recklessness punished. When public money absorbs losses, that discipline vanishes. Not all bailouts are equal, however. Some include conditions, government equity stakes, leadership changes, caps on dividends and bonuses. These measures can reduce moral hazard by showing that rescue carries a price. But even then, the precedent is set. Once an institution is saved, others take note. They adjust future behavior accordingly. Past bailouts become part of present risk calculations. There's a deeper problem. Systemic risk is often invisible in good times. Excessive risk doesn't look dangerous. It looks profitable. Models show low volatility. Profits rise. Leverage seems smart. Early warnings get ignored. And if regulators are too cautious, too late, or too influenced by the industry, they allow the buildup to continue. Then, when crisis hits, the system is too fragile not to save. The bailout becomes inevitable, not because the danger was unpredictable, but because prevention failed. That is the heart of the moral hazard paradox. Intervention is necessary when the cost of inaction is collapse. But each intervention makes the next crisis more likely by encouraging behavior that assumes protection. The system becomes trapped. Risk leads to crisis. Crisis leads to rescue. Rescue leads to more risk. Breaking the cycle is hard. It requires allowing failure, and that comes with pain. The ideal solution is structural. Strong oversight, clear rules, and limited safety nets that contain damage without removing accountability. But that's a political challenge. It requires balancing economic stability with moral clarity. It means building systems that don't need bailouts and having the courage not to offer one when the time comes. Because in the long run, unchecked safety nets don't just prevent failure. The simplicity paradox. The most effective investment strategies are backed by data, easy to understand, and tend to outperform complex ones over time. A simple approach: buying a low-cost index fund, reinvesting dividends, holding for decades, avoiding market timing, and staying diversified, beats most active funds, stock pickers, and traders. Yet, many investors abandon it, drawn instead to complexity. They seek secret formulas, advanced algorithms, expert insights, or market predictions, believing that a sophisticated approach must be superior. This paradox stems from a fundamental human instinct, equating complexity with intelligence. People assume a strategy with more variables is smarter, a portfolio with more holdings is better diversified, and an investment model using advanced math is safer. In many fields, complexity signals expertise. A doctor's detailed diagnosis or a lawyer's intricate explanation seems more convincing than a simple one. The same bias influences investing, leading people to believe that complex strategies must have an edge. However, financial markets don't reward complexity as expected. Markets are noisy, adaptive, and driven by behavior, punishing overconfidence. The more moving parts a strategy has, the more chances for failure. Timing must be perfect, assumptions must hold, and inputs must stay relevant. When markets change, as they always do, complex models often fail, while simple strategies continue working. They don't predict, they participate. Consider dollar-cost averaging, investing a fixed amount at regular intervals, regardless of market conditions. This strategy doesn't attempt to time the market. It simply spreads out purchases, reducing volatility and steadily building wealth. It requires no forecasting or deep research, yet outperforms many sophisticated strategies. Still, many dismiss it as too basic. The same applies to index investing. A total market or S/P 500 fund provides exposure to hundreds of companies at minimal cost, requiring no active management. Decades of research confirm that passive index funds outperform most actively managed funds, especially after fees. Yet, investors continue pouring money into high-fee funds and hedge funds, believing complexity offers control when in reality, it just increases the risk of failure. Active management is not just more complex. It also feeds ego. It gives investors the illusion that they can outthink the market, spot trends, and add value through their insight. While some succeed, consistent outperformance is rare, requiring exceptional skill, discipline, and luck. Most investors, retail and professional, underperform over time but persist, believing complexity gives them an advantage. Beyond investing, this desire for complex solutions leads people astray in financial planning. Instead of following simple, proven principles, spend less than you earn, save early, stay insured, avoid debt, invest steadily, and don't panic. They chase elaborate strategies, exotic insurance products, and tax maneuvers that often leave them worse off. The simplicity of a sound plan makes it unattractive, leading people to seek something that feels more sophisticated, even if it's unnecessary or counterproductive. Boredom plays a role, too. Simple strategies require patience and consistency, but investors want to act, tweak, and optimize. They follow the news, check markets, and make frequent trades, each decision introducing the risk of getting it wrong. Simplicity removes unnecessary decisions, making it easier to avoid costly mistakes. Social pressure further reinforces complexity. Saying, "I own an index fund," doesn't impress, but talking about algorithmic trading or alternative assets does. People want to sound knowledgeable, so they complicate their approach. Financial professionals are not immune. Advisors, analysts, and portfolio managers need to justify their fees. If they simply recommend an index fund and do nothing else, clients might question their value. So, they add complexity, more asset classes, alternative investments, frequent rebalancing, and market forecasts, creating the appearance of expertise, even when results lag behind a basic benchmark. The same pattern appears in backtesting. Many complex strategies look brilliant in hindsight because they were designed to fit historical data. Rules like buy when this crosses at or rotate sectors at certain levels create impressive backtests but often fail in real time. The strategy wasn't insightful. It was just overfit to past patterns that no longer apply. In contrast, simple approaches endure. A 60-40 stock bond portfolio, a target date retirement fund, or a steady savings habit. These may not promise outperformance, but they keep investors engaged, prevent catastrophic mistakes, and often surpass complex strategies that react to every market signal. Simplicity trades the illusion of superior returns for the reality of staying invested, and that trade usually wins. Some of the most successful investors understand this. Warren Buffett recommends index funds for most people. Jack Bogle built Vanguard on the idea that low-cost simplicity beats high-cost complexity. Even Ray Dalio, known for his intricate macro models, emphasizes fundamental principles like diversification and discipline. The best investors use complexity only when it adds real value, not for its own sake. Behavioral finance explains much of this paradox. Humans are overconfident, believing they can outperform the average. They seek patterns where none exist and assume that more information leads to better decisions. In reality, more data often creates more noise. Simple strategies avoid this trap by reducing decision-making and emotion, which adds more value than most complex analyses ever could. But simplicity doesn't sell. It doesn't make headlines, attract assets, or give people a sense of action. Complexity, on the other hand, feels exciting. It provides something to buy, something to trade, something to believe in. Yet, most of it doesn't work. The simple path is the one most people ignore, even as it quietly outperforms the rest. That's the paradox.